political system is showing absolutely no signs of slowing down the borrowing. And this is going to continue to rattle bond market holders.
What the bond market is worried about is that over the longer term, it will increase the deficit.
Congress is not doing its bit, so the bond market has to force Congress to do its bit. And so I think that's why the long end is scary.
The number one risk right here and now is that long-term bond term premium.
We could have a debt crisis scare.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Live from New York City this morning. Good morning, good morning. For our audience worldwide, Bloomberg Surveillance starts right now. Coming into Thursday, it's Washington versus Wall Street.
You have one or two no's. You never can be certain. This is a massive piece of legislation with lots of moving parts. So we'll see what happens. But I think we're going to get this job done, and we're going to do it by Memorial Day.
The White House doubling down as Congress makes a move to vote on the tax bill. The bond market pushing back, investors sending 30-year yields back through 5% as the issues are beginning to pile up worldwide. From London all the way to Tokyo, the bond jitters go global.
Absolutely. And right now, what everyone in the United States is focused on and whether or not Speaker Jonathan, can land this plane, as he said, this massive tax cut and spending bill. One thing we should note, everyone that's waking up and excited, potentially there might be a vote. Hakeem Jeffries is speaking right now. He is the minority leader, and he doesn't have a clock. He can speak for as long as he wants, so he might want to wake up for more Americans to explain why the Democratic Party does not think this bill should pass. But momentum is behind Speaker Johnson, and he's going to get likely his vote before Memorial Day.
You're looking at live pictures down in Washington, D.C., and here's some live pricing right here on Wall Street. Bond yields, the 30-year, back through 5%. Yields up yesterday, down a touch this morning by a single basis point, 5.08%. My question, I think a question for a lot of people on Wall Street, how much does this matter to these people in that room right now?
I really don't think they care. There's a few individuals like Representative Chip Roy, who yesterday quote tweeted someone who was talking about the terrible 20-year auction we had and said noted. But does that mean that these individuals are going to stop with this spending package? No, they just are like, yeah, the bond market may be a little bit yippy, but we're all systems ahead and we're moving ahead with our package.
We certainly saw those yips in yesterday's session. We'll see if we have more to come in today's. Coming up this hour, Seema Shah of Principal Asset Management as bond markets rattle investors. Rob Casey of Signum and why the big beautiful tax bill might not make its Memorial Day deadline, and Sam Zief of JPMorgan on the need to diversify currency exposure. We begin this hour with our top story. Bond yields back through 5% as House Republicans look to strike a tax deal. Bloomberg's Tyler Kendall joins us now from Washington for more. Tyler, take us into the room. How soon before we get that vote?
Yeah, hey, John. Well, House Republicans are expected to vote really any moment now. But as Annmarie mentioned, it's really going to be up to when Democratic leader Hakeem Jeffries stops speaking. And he has unlimited time on the clock, which could delay this further. But ultimately, the signs are looking rather positive for House Speaker Mike Johnson, because this legislation did pass a key procedural hurdle earlier this morning. It was seen as a test vote to get this bill onto the floor. And ultimately, he only lost one Republican member. That was Thomas Massey of Kentucky. No one was really expecting him to vote for this legislation. He has long said that he will not support a bill that adds to the deficit. So we're going to have to wait and see exactly when this vote is going to happen. But at the moment, John, it's looking positive for the speaker.
Tyler, 18 hours they spent in the Rules Committee. Then we finally got the text very late last night of what changes we heard that were being done behind the backroom dealings. What actually happened? Where we are SALT and where are we in Medicaid?
Right, exactly. Those were the two big provisions that we were waiting to see what they agreed to. Now, when it comes to SALT, we have learned that they will lift that cap from $10,000 to $40,000. That number would then phase out for individuals that have incomes over $500,000. Both that income threshold as well as that cap will increase by 1 percentage point each year for the next 10 years. Now, that would be to appease those Republicans from those high tax states like New York, New Jersey, California that were holding up this bill, in a bid to appease the other members that were those fiscal conservatives that wanted to see some deeper savings policies. We have learned that they will speed up the implementation of Medicaid work requirements to December of 2026 instead of the originally proposed 2029. They're also going to eliminate those clean energy tax credits under the IRA by 2028. To be sure, not everybody is happy with this final agreement, but it does appear that this could be what ultimately gets the deal done because, Annmarie, as you know, President Trump really ramped up the pressure on these House Republicans yesterday, saying that anyone that doesn't vote for it, it would amount to a, quote, betrayal to his ultimate economic agenda.
Tyler, thank you. Stay close. Tyler Kendall down in Washington, D.C. So here's the scene. Hakeem Jeffries, the House Minority Leader, holding the floor at the moment. Early morning in Washington, D.C. They've been up all night. He's going to hold the floor for, I imagine, the next hour or so. Then at some point, he's got to give it up. And we're going to see a vote in Washington.
At some point. Maybe a minimum he'll speak for 60 minutes. He can go much longer. He actually just recently said while he was speaking on the floor, every time I'm interrupted, it'll add another 15 minutes to my remarks. But once he is done with this, and a lot of this is performative, but he does want to make his voice heard to the American people, and it's very early right now. So maybe he goes for a few more hours. Then there's going to be a vote, and that vote's likely going to pass. But Jonathan, this is the easy part for the House. This is the easiest week potentially for Speaker Mike Johnson when it comes to the one big beautiful bill. The Senate is going to jam him in a few weeks or months' time with all the tweaks and edits that they want to see.
Hakeem Jeffries is being heard right now. The voice of the bond market was loud and clear in yesterday's session. Here's the view on Wall Street. Seema, Shah of Principal Asset Management writing, the fiscal deal will very likely expand the deficit, attracting bond vigilantes and driving up long-end bond yields. Seema joins us now for more. Seema, welcome to the programme. A 20-year auction. Now, a 20-year maturity for a lot of people in the bond market, not a great maturity. A weak 20-year auction for a lot of people in the bond market, not worth paying attention to. Why was it so important this time around? Is it a reason to sell or an excuse to sell?
Hi, John. Well, I think you're right. I mean, I think when we're thinking about this, is it a cause? Is it a symptom? And as you said, a weak 20-year auction is not unusual. It typically has less demand anyway. But we've already seen in the last couple of weeks, and particularly this week, especially after the Moody's downgrade, that there's been this narrative of concerns, which has been like a hum, which has been growing louder and louder, of concerns around the deficit. Now, if we had spoken maybe 3 or 4 months ago, at the end of last year maybe, and somebody had said, you know, when does the US really need to confront its debt issues? A lot of people would have said, you've got another decade or so. Increasingly, it feels like this administration is going to have to confront the problems because the bond market has lost patience and is really going to force the issue through to make sure that there is some realization that continuing to expand its deficit, its debt numbers indefinitely, is simply not something which can continue.
Seema, let's talk about levels. Life above 5% this cycle on the long bond hasn't been sustainable. How problematic is this level? How self-limiting is this move?
Well, I mean, if we think about it in terms of the 10-year, there's always some thresholds which are thrown around. Typically, it's been the 5% level is the bit where the equity market really starts to stumble. I think increasingly, because we've seen growth downgrades over the last couple of months because of all the issues around tariffs, we're probably looking at a slightly lower level in terms of equity market resilience. For us, we're looking at a 475 handle. Of course, it depends the speed at which we get to that point, and of course, what the reason is. If the reason is because of better growth expectations, that's okay. If it's really around concerns around the fiscal side, well, that's a slightly different story. So we think that the equity market already is being somewhat pressured, but I think the pressures would likely grow if you start to cross that threshold.
Seema, we saw the bond market be one of the reasons why Donald Trump, the president, actually reversed course when it came to tariffs. Do you think potentially the bond market has a vote when it comes to this fiscal package?
I think it definitely has some kind of say. And, you know, as to your point, I think one of the reassuring factors for investors over the last couple of weeks is trying to understand and know that Trump does have a pain threshold, and it's not necessarily the equity market, it's actually the bond market. So seeing yields rise, potentially continue to rise, could be the point where you do start to see a slightly different narrative. It is difficult how they step back from here. When I'm looking at the US, unfortunately, I'm reminded a lot about the UK. In that situation where the UK government has got a deficit issue, it needs to introduce some kind of tax increases. The market doesn't like that because of the impact to growth. If it increases tax, well, then it's worried about deficits. So the UK is increasingly locked in a very, very tough place. And unfortunately, to me, it looks like the US is heading very close to that point, too.
You say there's a level. What is that level?
Well, in terms of the bond market?
Yes, for the Trump administration and potentially Republicans in Washington.
Well, I think for Trump is one thing, for the Republicans in Washington, it may be a slightly different level. 475 is the handle that we typically are looking at, especially now. We think that the level has come down from a 5% handle just a few months ago or so. But for the Republicans in Washington, I don't know how much notice they could be taking of the bond market. They know it's happening. Whether or not they actually start to act on it is a different one. So really, I think it comes down to the president and how much comfort he feels with regards to how bond markets are moving.
If you're just tuning in, welcome to the programme. You're seeing live pictures in Washington, D.C. of the House Minority Leader, Hakeem Jeffries, getting close to wrapping up his comments on the House floor, using the phrase, as I close.
As I close. So he's in his final remarks, which means, and I do seeing here that Speaker Johnson is back on the floor, checking his phone, potentially making sure all of his Republicans are coming to the floor. We could see a vote in the next hour. If he wraps this up, then we're going to go into the procedure of this vote hitting the floor.
Seema, a lot of people are talking about a so-called reverse TARP moment. Not the markets forcing Congress to pass a bill, but the market forcing Congress not to. Do you think we're being a little bit too dramatic? How close do you think we are to a moment like that one?
I'm not sure that we're that close. I mean, when you've seen the moves in the Treasury market, it's shocking to some extent, but these aren't levels that we haven't seen in the last year or two. This has been a level that keeps getting pushed. So I don't think it's that point. And you also have to remember that this is a global move. Trump can certainly point to the fact that we've seen the sell-off in Japan, we've seen the sell-off in the UK as well. So I'm not sure how close we are to that point, but I think from Trump's perspective, he does really need to think about the growth story, because one of the factors is that if you have really strong growth, a lot of the equations become much easier. If you've got growth for 2025 sitting around a 1.5% handle and looking to be below trend for the next couple of years, well, then he needs to think about what are the growth-friendly measures he's going to bring in. What does he do with tariffs? What does he do with the tariff revenues? So I think there's a lot of questions which doesn't necessarily come down to specifically this tax bill, but what are the other measures that he needs to consider in this whole process?
Seema Shah, appreciate your time, as always. Seema Shah there of Principal Asset Management, really underlining the global aspect of all of this. It's not just these scenes right here down in Washington, D.C. It's Japan, it's the UK. It's global.
That's a few people actually messaged me yesterday and saying, Annmarie, I know you're so focused on the fiscal package, but when it comes to bond yields, there are other issues at play. There was a really bad auction in Japan. There was higher inflation in the United Kingdom. You cannot look at this as idiosyncratic just to the United States. But right now, we do have House members debating this package, which the CBO, Jonathan, says is going to add trillions over the next 10 years.
Hakeem Jeffries wrapping up his comments on the House floor. Let's cross over back down to Washington, D.C. to catch up with Tyler Kendall. Tyler, walk us through the process here, the procedure. They've been up all night. What happens next?
Right. So they're going to start to vote on this package. And, John, the magic number, if everybody shows up that we are expecting to, is going to be 217. That is the number that House Speaker Mike Johnson is going to need in order to pass this bill on the full House floor. Now, that means that with the 220 majority, he can only afford to lose 3 Republicans. We already know one is a firm no. That's Thomas Massie of Kentucky. He did not vote in favor of what was that procedural vote that we saw earlier this morning. But that still gives him some buffer room here. And at the moment, it is looking likely, because those fiscal hawks were really the ones that we were expecting could be some of those dissenting votes, those names like Chip Roy, Ralph Norman. But at the moment, it does seem that they might have been appeased by that compromise agreement to speed up those Medicaid work requirements, as well as speed up the ending of those clean energy tax credits under the IRA.
Tyler, stay close. We're getting closer here. Speaker Johnson on the floor speaking right now. We'll come back to those pictures in just a moment. I want to get you an update on news elsewhere with your Bloomberg brief. Here's Yahara Arnott. Hey, Yahara.
Hi, John. The House is in session right now, conducting a final debate ahead of a vote on a new version of President Trump's One Big Beautiful Bill. Minority Leader Hakeem Jeffries just ended his speech. The new version of the bill includes a higher $40,000 limit on the SALT deduction. It speeds up work requirements for Medicaid and puts an end to Biden-era clean energy tax breaks. Meanwhile, U.S. Secretary of State Marco Rubio said Venezuela's oil export license will expire on Tuesday, defying earlier expectations that it would be extended. Rubio posted on X the pro-Maduro Biden oil license in Venezuela will expire as scheduled on May 27th. The tighter time frame puts pressure on Chevron's operations in the sanctioned nation. And a deadly shooting in Washington. 2 staff members of the Israeli embassy were shot and killed while leaving an event at the Capitol Jewish Museum. The suspect was identified as 30-year-old Elias Rodriguez of Chicago. Police say when he was apprehended, he yelled, "Free, free Palestine." That's your Bloomberg brief. John?
Yahara, thank you. More from Yahara later this hour. Up next on the program, pushing the tax bill over the line.
We have 1 or 2 no's. You never can be certain. This is a massive piece of legislation with lots of moving parts. So we'll see what happens. But I think we're going to get this job done, and we're going to do it by Memorial Day.
Up next on the program, Rob Casey of Signum Global Advisors joins us next, live from New York City this morning. Good morning. Speaker Johnson on the House floor right now, live in the nation's capital in Washington, D.C. Moments ago, it quite literally is morning again in America. Good morning, Mr. Speaker. Good morning to all of you tuning in. They've been up all night. I hope you've had some rest. In this bond market, this equity market, our attention is on these scenes right now as the House inches closer and closer to a vote in Washington, D.C. Equity futures at the moment elevated by just 0.1%, up 0.2% on the Nasdaq. In the bond market, yields coming back very close to multi-decade highs at the long end of the curve. The 30-year yield this morning is lower by almost a basis point, 5.08%. Under surveillance this morning, pushing a tax bill over the line. Here's the latest. The full House vote on the president's tax bill could come any moment after a revised version was released overnight in an attempt to win over Republican holdouts. Joining us now, Tyler Kendall down in Washington, D.C., Rob Casey of Signum Global Advisors. Tyler, I want to come to you first. How close are we and how tight are these margins?
Yeah, hey, John. Well, we're getting some new information that the margins might be even tighter than we expected. I mentioned this before. It appears the magic number that House Speaker Mike Johnson is going to need is 217 Republicans to vote in favor of this. That means he can only afford to lose 3. We already knew one, which was Thomas Massie. And just in the last few minutes, we've heard from another. That's Warren Davidson of Ohio, Republican from Ohio, who had already started to discuss his concerns when it comes to how this will increase the deficit going into today. Yesterday, he actually posted on X about his concerns when it came to the bond market. But just in the last few moments, he posted on X saying that while he loves many things in this bill, promising someone else will cut spending in the future does not cut spending. So it appears now that that means Mike Johnson only has one more vote that he could lose.
Rob Casey, your thoughts on the numbers and whether this passes?
Well, up until yesterday evening, we did not expect this to pass today. I think for the simple idea that A, the House Freedom Caucus members were not there yet in terms of what they actually saw in the package, and B, they've worked through the whole night. There's no deadline tonight. There's no deadline today, except for Speaker Johnson's, made-up deadline. So to his credit, it does seem as though he's really rushing this through, and people are convinced that today is the day. Overnight, we did see some coalescing around the bill as it exists today. So, you just heard from Tyler. It's still really, really tight. We haven't heard from Chip Roy and others, but they voted for the rule. And as of this morning, Johnson is projecting confidence. So I think that they're much closer than they were 6, 12, 18 hours ago.
And they all just sat down in the Oval Office with the president just hours ago. Did he close this for the House Freedom Caucus members?
I think he did. What he didn't do was close it on Tuesday morning. It does seem as though the second meeting on Wednesday, a little bit more targeted towards the House Freedom Caucus. In fact, very targeted. Not, once they got the SALT deal over the line, the Freedom Caucus members were the only holdouts. It does seem as though that meeting helped.
Do you actually think Speaker Johnson would bring this to the floor if he didn't think he had the votes?
I think he actually would. We used to see Speaker Pelosi. She essentially never lost a vote on the House floor. I think Speaker Johnson takes a little bit of a different approach. He's willing to lose a vote, first vote, second vote, if it gets him to the winning vote, third vote, fourth vote. But it seems as though, he's pulling together the numbers earlier than later.
Help us understand what you think the ultimate compromise will be. How has this bill changed in the last few days? And what do you think the compromise looks like at the very end?
Well, really interestingly, the changes that we've seen over the past couple of days are essentially moving in the opposite direction of where the Senate is going to take this bill, right? We've seen a higher SALT cap. There are no senators from New York, New Jersey, and California, so there are no senators who are going to be happy with that. And we've seen, earlier phase-outs of some of the IRA spending, in fact, a lot of the IRA spending, and some of the Medicaid cuts. And there are certainly some senators who are happy with that change. There are other more moderate senators, who hope to stick around in their seats for quite a lot longer. And I think, generally speaking, they would be more willing to kind of look the other way on some of these cuts.
Tyler, this is the ultimate problem. This is the beginning of the end of the beginning. We're nowhere near getting this done. And once you get it done in the House, it's got to go to the Senate. And the biggest question we've all had is, can you please the Soul Caucus and the Hawks in the Senate at the same time? And obviously, that's going to be very, very challenging in Washington.
Very challenging, John. And there's just a whole list of items that we already know that the Senate wants to change in this bill, including making permanent the 2017 tax cuts, since the House version only extends them temporarily. Not to mention that we're talking also about lifting the debt ceiling. This House package lifts it by $4 trillion. The Senate wants to see that up to $5 trillion. Not to mention, when we are talking about these individual provisions, like we know that the Senate doesn't want to touch when it comes to Medicaid. When you talk about SALT, John Thune, the Senate Majority Leader, historically not a fan of lifting that SALT cap. In fact, December of 2021, he wrote a pretty strongly worded op-ed entitled "Salt in the Wound." That was when Democrats were trying to lift the cap back then, and he said that he just couldn't support it.
You know the timeline. It's Memorial Day, self-imposed for the House. They want this done by Independence Day, wrapped up on the president's desk by July 4th.
Speaker Johnson, his final words there when he's speaking on the floor, predicts they're going to deliver it to Trump's desk by Independence Day, and says the Senate, Trump is waiting with his pen. So basically saying to the Senate, you got to get a move on. If we're hitting Memorial Day, you need to get it back to us to give us time to get this to Trump's desk July 4th. There are some people in Washington, D.C., like Terry Haynes of PGIM Policy, who thinks 80% it's done by July 4th. I spoke to Libby Cantrell yesterday, too. She says, I think more like August.
Bond market jitters kicking in the last 24 hours. A 30-year yield back through 5%. Rob, how important is that? Does anyone in that room right now care about what's happening on Wall Street in the last 24 hours?
I think very few people do. The House Freedom Caucus, Chip Roy in particular, likes to tweet about it. And I think to the extent that Moody's downgrade changed any of these conversations, it was giving the House Freedom Caucus some further ammunition to demand further cuts. I think the same can be true of bond market reaction, right? Chip Roy, among others, can point to it and say, we have to find some more cuts. There just aren't that many more cuts to find.
So it's convenient for them right now. The bond market's pushing back. That's all it is.
Yeah, exactly.
It's convenient.
Exactly.
Do you think the president, though, cares? Not members of Congress. The president cares when he sees these yields. And Scott Bessent, the Treasury Secretary, cares, given the fact that we know they've been squarely focused on the 10-year yield.
Yeah, I think they do care. But I'm not sure that that is the reaction that's going to, knock this package off the rails. They've put in more than 6 months worth of work at this point. If they can get it through the House as of today, they will immediately turn to getting it through the Senate, right? Pushing it through the Senate. Whether or not they can roll the Senate or not, in the short term, I still take the over in terms of timing. But I do not think that bond market reaction is what kills this package. I think it's the House and the Senate each wanting their fingerprints on the bill from here.
Well, the Senate's going to jam the House. This, I've been saying, is actually the easiest week for Speaker Johnson if you look at long-term where this bill is going. The tweaks, it's going to get moderated in the Senate. How does he get the votes when it comes back?
I think it's going to be really hard for him to get the votes. President Trump is going to have to either return to the Hill or welcome members back into his office, maybe more than once, as he did this week. It's why I still take the over, right? It's not to say that we don't expect this bill to get done. I mean, the truth of the matter is it really has to get done, or else we'll see historic tax increases under a Republican trifecta. But as we were talking about, made-up deadlines, it either gets done before the debt ceiling, we hit the X date, or it doesn't. We still take the over there.
At the very least, you extend TCJA. What is the extra? Can they go beyond just doing that?
I think they can go beyond. I mean, we've talked for months about how there are not many members in Congress who like no tax on tips, no tax on overtime. I mean, quite literally, you talk to them in the room and they say very explicitly, it's not very good policy, right? It's not pro-growth policy, but it's what the president has demanded. So they've actually written those parameters very narrowly. They're in the bill, but kind of in name only.
They were key campaign promises, not just by the president, by the way, but also on the other side of the aisle. Kamala Harris, when she was running, made some of the same promises.
Absolutely. And the president yesterday, there was a White House memo sent around that said this would be the ultimate betrayal to the American people because he ran on these policies, not just the extension of TCJA, but all those extra sweeteners, no tax on tips, et cetera. He wants to see them in the bill because he wants to deliver what he promised on the campaign trail.
Rob Casey of Signum Global Advisors. We're going to push you to stick around, if that's all right. Tyler Kendall down in Washington, D.C. All eyes on the House as we push for that first vote on that one big, beautiful bill. This bond market pushing back in yesterday's session, a 30-year yield back through 5%, and we held on to those levels. The 30-year this morning just about unchanged, 5.09%. Up next, we'll talk about tax policy and trade policy too, with the former senior Trump trade advisor, Kellyanne Shaw. 2 days of losses on the S&P 500 this morning so far, positive by just 0.1%. Yesterday's losses triggered by developments in the bond market. Typically, the 20-year auction is not something you pay a lot of attention to. Nothing to worry about. It's the 20-year maturity, which isn't something that's like that much in the bond market. But I have to tell you, yesterday, that worried people. On top of all the other worries, in Japan, in the UK, a big tax bill going through in Washington, D.C. Yields are higher at the long end of the curve in the last 24 hours, back through 5%. This morning, just a little bit of stability. The 30-year, 5.087%. With 3 hours until the cash open, your morning movers look like this. Here's Yahara. Hey, Yahara.
Hi, John. No worries for Urban Outfitters. That stock is up 18%. Now, it blew past first quarter expectations, and they see no signs of that slowing down, with shoppers still hungry for fresh spring fashion. So they expect the second quarter to be strong as well. As for how they're handling tariffs, they're negotiating costs with suppliers and say they want to limit price hikes to only higher end items. Next up, we have some M&A action for you. We are seeing shares of Lumen rising 13% after AT&T agreed to buy its residential fiber unit for $5.75 billion. And the reason why Lumen is soaring is because the move allows it to offload a non-core unit and focus on its enterprise customers. Not as much love for the buyer, though, AT&T. And last up, we have Manchester United. Those shares are falling 7% after a costly loss in the Europa League final. The defeat to Tottenham means no Champions League next season and no European competition at all, which of course has a lot of financial ramifications for them. But we're happy for the Spurs here, who had been waiting to hoist the trophy for 17 years. John?
Brutal. Yahara, thank you. I have to say the quality of the football yesterday evening has no place in the Champions League. That's my saying all of that. On a radar this morning, the House set to vote any moment on a new version of President Trump's tax bill. The latest version was released overnight in an attempt to win over Republican holdouts. We're following the scenes live in Washington, D.C. Just how performative is this moment?
Well, overall, it's very performative because in the end, this bill, if it passes, and looks like it likely will, even though we do know there are 2 Republicans who are a no at this moment leading into this vote. Right now, we are on a procedural motion to recommit, which is a Democratic procedural. But if this passes, it goes to the Senate. They are going to sanitize this bill. They are going to change the edits the House made when it comes to Medicaid, when it comes to SALT. Rob Casey brought up a great point. Do you see any Republican senators from high-tax states like New York? No, they have no impetus to want to increase the deduction. So a lot of those things are going to be rolled back. And then Speaker Johnson actually has the big fight. That's going to be in a few weeks, few months' time.
I'm wary of overplaying this, but there is this interesting tension evolving now, starting to emerge between Washington and where it's going and Wall Street and where it's heading. And we saw it in the soft 20-year auction yesterday, $16 billion of 20-year bonds coming in just a little bit weaker. More auctions in the next week or so. We'll be watching the 2-year, the 5-year, the 7-year, and they're going to get more and more attention as the weeks and months go on as this bill comes together.
Right. So for the fiscal hawks, for the House Freedom Caucus, the auction, the bad auction, was a good excuse at the right time to say, look, what's happening in the bond market? We should be fighting for less spending. You saw that with Representative Chip Roy, which we don't know yet how he's going to vote on this bill this morning. He was talking about the horrible bond auction yesterday on X, as well as Representative Davidson, who already said he's going to be a note on this, talked about the rising bond yields. But overall, does Congress actually care? I would say no.
That's the situation in fixed income. I just want to turn to commodities. The president getting what he wants here as well. Crude's lower. WTI's back to 60. Brent's back to 63.80. OPEC Plus members are mulling a 3rd consecutive oil production hike in the month of July. Sources telling us here at Bloomberg they're discussing tripling the amount initially planned. The final decision will be made on the 1st of June.
So this is a combination of things. One, they are frustrated with the likes of Kazakhstan, Iraq, other individuals who Saudi Arabia and some others will say are freeloading on their discipline when it comes to the market. 2, now might be a time to go after market share. And 3, if you want to go after market share, you're willing to sweat out some of the lower oil prices. Why not do it at a time when it scores you, as Will Kennedy was talking about earlier this morning, a massive policy win to the President of the United States, who came to your capital and gave a transformative transformative speech when it comes to foreign policy and where he sees countries like Saudi Arabia.
It seems like this unwritten agreement right now between that region and the president. Crude is lower by 1.7%. That's the situation in markets. Here's the situation with policy. Let's turn to trade. The EU sending a new proposal to the US aiming to secure a deal with President Donald Trump. Sources telling Bloomberg the new plan focuses on US interests, including economic security and a gradual reduction of tariffs to zero for select goods. The former senior Trump trade advisor Kellyanne Shaw joins us now for more. Kellyanne, welcome back to the programme. It looks like we can strike deals with countries like the UK. How much harder is it going to be to come to an agreement on Europe? Because we've spent a lot of time on this over several decades and still can't get it done.
Yeah, thanks so much for having me. I think of all the countries who are lining up for a deal with the United States, the European Union is going to have the hardest time for the reason you've mentioned. We've tried to get a deal with them for the last 20 years unsuccessfully. Now, I do think it's helpful that they're proposing a new set of commitments to the United States. They had previously been taking more of this wait and see approach, see what other countries are getting, see if the president loses his political support for some of these tariffs. But it looks like they're trying to engage a bit more now. So that does open up an opportunity to at least try at another kind of deal, maybe similar to what the UK got.
Kellyanne, this morning we're looking to advance a tax bill through Congress. And I wonder, and I'd love your thoughts on this, if they manage to pass this by Independence Day, given the timing of the 90-day window that closes for trade negotiations, do you think this could embolden the president to go even harder on trade?
Well, I think clearly getting the tax bill over the finish line is going to help the president in terms of his tariff strategy. And that's exactly what Secretary Bessent was saying on Saturday on CNN when he was talking about, look, the tariffs may do one thing, but the tax bill is going to do another in terms of deflationary effect. So you have to look at our entire economic package. Now, I think the other thing that would help embolden the president is getting several more of these deals under his belt, showing that this plan is successful on the tariff front, but clearly some of these domestic measures are also going to help the president in terms of advancing his overall economic agenda.
Kellyanne, he has said a few times that there's a number of deals in the, quote, hopper. Who's up next to ink a deal?
Yeah, I think countries like Japan, South Korea, Vietnam are close to getting a deal. The administration keeps talking about 18 different countries who are key trading partners who have made serious offers with whom they're seriously negotiating. I put Switzerland in that mix, Israel in that mix, potentially some of the Latin American and Central American countries as well. But at some point, they're just going to run into this capacity problem, which you've heard several administration officials and the president talk about, where they're not going to be able to negotiate these individual deals. Rather, they're going to use the deals that they have and then use those as templates moving forward for other countries with whom there are potential negotiations down the line.
Building on John's initial question about the European Union, where are they in the Excel sheet? What number are they ranked?
Yeah, I mean, clearly the EU is a very important trading partner. The transatlantic trading relationship is one of the largest in the world. But in some instances, in some cases, the Trump administration is probably going into those negotiations not particularly optimistic that they're going to be able to get a deal because, again, of the dynamic that John started with, which is this is just something that has eluded both parties for nearly 2 decades. Now, that said, it's certainly worth trying, but I'm just not sure that that deal is really going to come together at the end of the day. I'm not particularly optimistic about it, but I think it's helpful that they've at least tabled potentially cuts to some agricultural tariffs, which are a huge priority for the Trump administration.
Kellyanne, we know Giorgia Meloni, the Italian leader, has a very good relationship with this administration. What I've been struck by is how many times the president talks about Ursula von der Leyen very warmly, the head of the European Union. Do you think that she is playing this very well when it comes to Trump and trying to get a deal across the finish line?
Yeah, I was also struck by comments where he referred to her as fabulous and fantastic. And I think that's really smart of the European Union. I saw staffing the president with a number of world leaders that where that chemistry is real and where those relationships are real, the overall dynamic between the two nations just went much more smoothly. And during Trump 1.0, the EU and the European leaders had a really hard time building an organic relationship with the president. So we've seen Meloni, we've seen von der Leyen, and we've seen others really making an effort this time. And I do think that that's helpful. I think that's a positive sign.
Kellyanne Shaw, the former senior Trump trade advisor. Kellyanne, wonderful to catch up with you. Thank you. We've said repeatedly this could be the harder deal. The Europeans versus the president.
Absolutely. And there's going to be other issues when it comes to the European deal. Secretary Rubio was just talking about NATO and how their defense spending is going to go up. So there might be other levers that Europe can pull. But this is going to be so challenging because it is a collective group of individuals, states, and countries. And this president likes to deal in a more bilateral manner.
Rob Casey of Signum is still with us. Rob, I just want to talk about a couple of dates. One, for the tax bill, the goal July 4th. The other, for the 90-day pause, expires July 9th. How important are those two dates? Does one relate to the other?
Well, I mean, we were talking offline. I think that they could relate to one another in that if they get this tax bill done by July 4th, then it gives President Trump some more latitude, some more leeway to say, listen, we've gotten to the end of the expiration. And in fact, you know, we've been talking to 18 countries. We've gotten a deal done with the UK. And we're not at deals yet, and so we're going to slap tariffs back on, right? So I do think if they succeed by July 4th, maybe there's more leverage. If they succeed by July 4th, then I will have been wrong because, again, we still take the over when it comes to how
When you say the over, what kind of date are you thinking about? End of summer, into the fall, end of the year?
Well, I think that the most salient deadline is the X date as of today, right? And so we've heard that that's going to come in August, which means that the Senate has to pass their bill before their August recess, kick it back to the House, and they have to essentially agree on two bills before the August recess. Honestly, if we get close to the X date, I think we could see Republican leadership pull a debt ceiling solution out, which actually has the convenient, additional change of forcing some Democrats to vote for it, right? I think getting some Democratic names on a lift of the debt ceiling, it might be better than worse.
This is exactly what I wanted to ask you, because then does that help the individuals from the House Freedom Caucus to then maybe sign up for the one big beautiful bill if the debt ceiling is a separate vote?
Exactly, because members like Thomas Massie and Chip Roy then don't have to vote for an increase in the debt ceiling, which is not to say that Thomas Massie will vote for any of this ever. But if they don't have to vote for the debt ceiling, indeed, maybe they come back post-August recess. And, the mood music's a little bit better, the tensions are a little bit lighter, and they're able to get this done in September.
Rob Casey of Signum is going to stick with us. We'll continue to monitor developments down in Washington, D.C. as we get closer and closer to that vote in the House. In the bond market at the moment, things are stable. We're settling down. Yields are down by about a single basis point on a 30-year to 5.08%. On 10s at the moment, let's call it 4.58, and down by close to 2 basis points. That's the situation in financial markets. Let's give you an update on stories elsewhere this morning. With your Bloomberg Brief, here's Yahara. Hey, Yahara.
Hi, John. U.S. House members have been working through the night to try and push President Trump's tax bill over the line, which you were just discussing. A new version of the bill includes a higher $40,000 limit on the SALT deduction, speeds up work requirements for Medicaid, and puts an end to Biden-era clean energy tax breaks. A vote could start at any moment. Meanwhile, President Trump says he's considering taking the U.S. mortgage giants Fannie Mae and Freddie Mac public. The companies have been under federal government oversight since 2008 when they were bailed out during the financial crisis. But in a post on Truth Social, Trump said Fannie and Freddie are doing well, throwing off a lot of cash, and the time seems right. And shares of Nike are higher in the pre-market, up 2.2%. The world's largest sportswear company announced it's returning to Amazon's online store for the first time since 2019. The return to Amazon is part of Nike CEO Elliott Hill's push to revive relationships with retail partners, including stores like Dick's Sporting Goods and Foot Locker. That's your Bloomberg Brief. John?
Yahara, thank you. More from Yahara in the next hour. Up next on the program, Washington versus Wall Street.
The bottom line is that this bill is going to lead to probably 3% growth again, just like we promised last time. That's going to create a lot of certainty in markets.
Up next, we'll catch up with Sam Zief of JPMorgan Asset Management, live from New York City. You're watching Bloomberg TV. Things are a little bit calmer as we inch towards that first vote on the one big beautiful bill. Down on Capitol Hill in the House, equity futures at the moment on the S&P up by about 1/10%, up 0.2 on the Nasdaq. Lots of drama in the bond market yesterday. No real drama this morning, but we hold on to those levels on a 30-year, closing above 5%, 5.0859% this morning. Yields just about unchanged. Under surveillance this morning, it's Washington versus Wall Street.
The bottom line is that this bill is going to lead to probably 3% growth again, just like we promised last time. That adds $4 trillion in revenue. It makes it so this bill pays for itself. That's going to create a lot of certainty in markets. There are way more spending cuts to come this year because of all the savings that we're finding.
Here's the latest this morning. Markets pushing back on Washington's big, beautiful bill. The White House responding, saying economic growth will outweigh Wall Street's fiscal concerns. Sam Zief of JPMorgan writing, we're shifting to a bearish stance on the dollar. Diversifying currency exposure can mitigate potential losses associated with dollar depreciation. Sam joins us around the table. Sam, good morning.
Good morning. Thank you.
Here in New York, on Wall Street, we like to believe that down in Washington, D.C., they have a live feed of what the bond market is doing and they follow these auctions really closely. How close to the truth is that?
Well, I hope that they are, because the market is going to vote on this itself, right? And I think you're starting to see signs, and it's not just in the bond market. I know we've talked about it all this morning, but the currency market is starting to vote with its feet also, differentiating between the currencies that have countries that have large trade surpluses, that rely on a lot of external financing for their budget deficits. Those currencies are getting punished. It's not just the dollar that's under pressure. British pound is under pressure. And the currencies that have trade surpluses, budget surpluses, are actually being rewarded, Norwegian krona. And so the FX market doesn't always trade this way. And so I hope that they are paying attention.
I'm pleased you picked up on this, and I think a lot of people are talking about the same thing up on Wall Street. The toxic mix between what's happening in the bond market and in foreign exchange at the same time. Yields are higher, but the dollar's weaker. Where's the money going with that in mind?
Yeah, and it does seem like global investors, rightfully so, have built up very large overweights to U.S. assets over the last 5-10 years. We are starting to see incremental signs of, it's not that there's a lot of selling of U.S. assets, but incrementally less inflows. So the one that I think is most interesting is European investors are actually putting money to work in their own equity market. They used to get inflows and then put it all to work in the U.S. And if the U.S., just because it has such a large trade deficit, has such a large current account deficit, just incrementally less inflows allows the dollar to leak lower. That's a key part of our thesis.
Is this a blip or is this a structural change?
No, we think this is actually the beginning of a dollar downtrend. And how long it lasts is anyone's guess. But the dollar from a starting point, 5-10% overvalued still, even after the move that we've had. We think that the dollar is going to stay under pressure over the next 6 to 12 months.
What does dollar downtrend mean for potentially de-dollarization?
Yeah, and so I'd focus that this isn't a view on global, let's say, financial institutions moving away from the dollar for cross-border lending, cross-border trade. You know, the dollar is still the center of the global financial system, but it is an effort to reduce the amount of dollar overweights that global investors have, or the amount that they've let their dollar assets kind of go unhedged, let's say. I think that those are really in play.
I've seen a lot of takes in the last 24 hours. This one jumped out. It's from Dario Perkins of TS Lombard over in London. It feels like that the Europeans are more angry about the situation than most at the moment. And this guy's based in London. Who knew that if you dilute the basic hedging properties of government bonds through supply shocks, attacks on Fed independence and thinly veiled threats against foreign investors, you would have to sell your bonds at a discount? Now, I'm trying to work out how much of this is repairable, reversible, with a change in policies. Markets have short memories. You can move on quickly. How much can be done in Washington to repair this?
Yeah. I think it's a slow process, right? I mean, so I was in London, and if you can bring that up in 2022, and when there was a little bit of a bond market riot against fiscal policies there, the trust moment, we all call it, and that form of government, the parliamentary system, was very easy to reverse, right? They got together, trust was removed, reversed all of those policies. This bill goes through in the U.S., regardless of how the market takes it. The U.S. system is not easily, lends itself to quick reversals. Not that I'm saying that that's necessary. But I think that, the U.S. process is just much, much more slower moving and harder to reverse, whichever way you go.
We're following that process right now in Washington, D.C. Annmarie, getting closer.
Right, we are getting closer. The House actually started voting on the one big beautiful bill. This is through the process of reconciliation. 217, Jonathan, the number to watch. We already know going into this, Johnson had 2 no's when it comes to Representative Davidson and Massey. Potentially, is he going to land this plane? We'll wait and see.
Rob Casey of Signum still with us as well. Rob, just walk our audience through what's happening now and what happens after this.
So, I mean, they're voting now, quite literally, but we like to say in the office, the numbers that you're seeing on your screen are not final, right? Any member can change their vote between now and the end of the vote, right? So if it turns out that we see 3 nays on there and then 4, there's the chance that Johnson could reel back a member or two and actually get this bill over the line. So those numbers are sort of interim. And then from there, right, the attention moves to the Senate. We all get our Memorial Day weekend off, right? Washington shuts down for 4 days. And then attention very quickly moves to the Senate and just how significantly they change what is coming out of the House now.
They always need a holiday, a vacation to get something done. And it's a very good point that this is the vote count right now, not until it ends, that's going to be the final tally, because we did have one Congress member briefly was a no, then switched to yes. So how long can this vote maybe stay open? Is Johnson going to have to do some wheeling and dealing live on the floor?
Well, I think he certainly probably is doing wheeling and dealing live on the floor. I've also read just on Twitter some great reporting being done that he's also getting handshakes and backslaps and hugs, right? So it sounds like maybe there's a little bit of a premature celebration coming from Republicans. It sounds premature to us, right? We don't know how they're going to vote. Maybe they all know that 2-nay on the board, that's where it's going to stand.
Let's do the big picture. This is just one piece of a very long battle for Speaker Johnson. How does he get the votes when the Senate jams him?
It's going to be really, really hard. So I think he's going to need President Trump, right, first and foremost. He also, I think, is going to have to demonstrate to his members that they are going to be the ones to have to, essentially argue and debate with the Senate, right? He gave SALT members essentially what they wanted, and he then said to them, you have to go out and convince the Senate, right? You, Mike Lawler, you, Elise Stefanik, et cetera, go over there, right, on the other side of the Capitol and talk to your colleagues about why this is important to you and your constituents. And if they can't do that, I'm not sure that Speaker Johnson is going to be the one to mend those fences. He can't do it alone.
If you think politics is frustrating, now for the market part, this is where it gets interesting. Is this positive or negative for financial markets? Now, we're told it's a net positive, good for stocks, but it could be bad for bonds, which could be bad for stocks. Sam, when you think about this bill, if this passes in Washington, D.C., is it dollar positive or dollar negative?
It's a great question. I do think that just given where we're coming from, dollar overvalued, we think that this global asset reallocation story is already underway. We think that that story continues, that this question over the U.S. Fiscal outlook, this increase in term premium we're seeing in the bond market will continue to be dollar negative. I think when it comes to markets, though, you've really got to segment. There's the dollar, there's risk assets, there's bond markets. Even within the bond market, there's different segments of the yield curve. Honestly, the more term premium rises in the long end, the more the long end of the yield curve tighten financials conditions, then the more the front end needs to stay low, needs to stay anchored. The Fed needs to offset that. So honestly, the more that we see volatility in the long end, the more comfortable we get in the front end of the yield curve.
Sit on that. Do you think the long end of the yield curve, cross-asset right now, is in the driving seat?
Yes.
And it drives the US dollar too?
Yes.
But in ways that typically we're not familiar with, which is yields are up and the dollar's negative.
Yep.
How much of a problem is that going to be going forward for a lot of people that have to hedge these issues?
I think that's the really main thing. It's not just that the long end of the yield curve is in the driving seat for the dollar, but also for risk assets. And what we've actually seen is a really sharp shift in the correlation between the dollar and risk assets. Usually the dollar exhibits these very strong safe haven properties. Risk assets sell off, dollar appreciates. But actually that correlation is now positive. For global investors, thinking about folks in Europe, folks in Japan, that have been used to having the dollar as this offset, this hedge to their U.S. assets, that shift in the correlation, even if it's been going in the right direction and U.S. stocks have been going up, still argues for increasing those hedge ratios that they've let fall. And again, that's what can put downward pressure on the dollar.
This is a massive change. We're all trying to track. Sam, it's good to see you. Sam Zief there.
Thank you.
Of JPMorgan, Rob Casey of Signum. Annmarie, getting closer to the outcome of this vote down in Washington, D.C.
We are getting closer. And Chip Roy, that Texas congressman that everyone's looking at, is going to vote yay, nay. He voted yes. So that's a win right now for Speaker Johnson as he tries to inch close to 217.
What did you make of the president's argument, which is basically just pass this thing? It's going over to the Senate. It will change. And we'll be talking about this again in a few weeks' time.
I think it's a good argument from the president because the bill is going to look completely different when the Senate sends it back to the House.
This market might look different too. Equity futures on the S&P positive by 0.1% and just a bit of stability in the bond market. The second hour of Bloomberg Surveillance up next with Alicia Levine of BNY Wealth, Bloomberg's Tyler Kendall, Eric Fisch of HSBC and Greg Peters of PGIM Fixed Income. Live from New York, you're watching Bloomberg.
soft data on the consumer is not strong. Outlooks from companies about the consumer were weak.
Corporate and personal balance sheets are in really good shape.
The pressure is eased, but the upside catalyst for earnings is not as robust as it was.
As you get into the summer, these potential downside risks to both EPS and GDP become a real issue.
It's a little bit fragile out there.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Live from New York City this morning. Good morning to you all. For our audience worldwide, live pictures down in Washington, D.C. as the one big, beautiful bill leaves the House and heads to the Senate. That passing just moments ago.
Passing moments ago, this is a huge win for Speaker Johnson, who promised a vote before Memorial Day. He still has days to spare. He was able to land this plane, as he said last night, coming back to the Capitol after having this meeting with President Trump and House Freedom Caucus members. And it does seem that the president was able to close the deal here, telling these individuals, vote for this bill. We all know it's going to change in the Senate, and then they're going to send it back to you, and then that's really when the fight's going to start.
And as that bill passes, look what happens in the bond market. Yields start to climb again, just by a basis point, but after a big move in yesterday's session, the 30-year yield right now, 5.1%. This bond market had its say yesterday in a big way.
The problem is, Jonathan, the bond market's having its say, but to who? Is anyone in Washington, D.C. listening? It is convenient that yields were rising yesterday when the likes of Chip Roy and Congressman Davidson were saying, look what's going on at the 20-year auction. Look at these rising yields. We have a deficit problem. We need to cut. We shouldn't be spending more. Okay, it was convenient for them. You don't take this vote if you really care. They don't care right now.
This doesn't happen often. Washington, D.C. getting some work done before Wall Street even gets to work, but it happened this morning. We begin this hour as the House of Representatives passes President Trump's big, beautiful bill onto the Senate. Tyler Kendall joins us now from Washington, D.C. for more. Tyler, welcome back to the program. A big development and unexpected around this table.
Yeah. Hey, John. Well, a big round of applause for House Speaker Mike Johnson as they passed this reconciliation package. The math changed on us a little bit because 2 Republicans were not there to vote, but it passed 215 to 214. One member voted present. That was Andy Harris, the chair of the House Freedom Caucus, who was raising those concerns about what this bill will do when it comes to adding to the deficit. Now, we did see some of those holdout members that we were sort of expecting to be on the fence here, including Chip Roy, ultimately vote in favor of this package. Now, what it does, of course, just to quickly recap, it will extend those 2017 tax cuts, also include some of those provisions we were watching, like temporarily eliminating no taxes on tips and overtime pay. When it came to those key agreements that needed to be included in this in order for a deal to be reached, it's going to lift the SALT cap from $10,000 to $40,000 and also speed up Medicaid work requirements to go into place by December of 2026, not to mention eliminate some of those clean tax credits under the IRA by 2028. Of course, as you've been covering, a lot of this is going to change once it gets over to the Senate, but this is considered to be a pretty big victory for House Speaker Mike Johnson this morning.
Absolutely a victory for Speaker Johnson. He promised this vote. He landed the plane. But, Tyler, what's on the chopping block in the upper chamber?
Right. Well, definitely changes when it comes to Medicaid. We know that this is something that senators have already been pretty vocal about, that they're going to roll back likely some of that timeline when it comes to implementing the work requirements. Not to mention, they also have some issues with how the tax provisions currently stand. They want to see them made permanent. Not to mention also, of course, increasing the debt ceiling. Now, the House plan, as it is passed, it would increase it by $4 trillion. The Senate wants to see that number boosted up to $5 trillion. Also, the IRA tax credits being rolled back. Many senators have already voiced concerns about what this will mean for the private sector and companies that have already been banking on using them, not to mention some of those states that are trying to transition their economies when it comes to clean energy. And then lastly, Annmarie, keep your eye on what's going to happen to SALT, because Senate Majority Leader John Thune historically hasn't been in favor of lifting that cap.
Tyler Kendall with the latest in Washington. Tyler, stay close. You've pleased some people in the House. Does that just annoy some people in the Senate? And are we back to square one again?
Well, I think the Senate just looks at it like, OK, the House, you've done your work. You've been extreme in some measures. Now we are going to what I think they really view as moderate or sanitize this. And I think SALT is going to be number one on the chopping block, because you have senators here who have no impetus to want to raise the SALT cap. Why would they do that? There's no Republican from a high tax state in the Senate. So this is the high watermark for $40,000 on raising that cap. And I think, if anything, it's going to go down.
This is the latest down in Washington, D.C. Here's the view on Wall Street. The bond market sending a warning to Washington. Alicia Levine of BNY Wealth writing this. Yields over 4.5% will bring volatility to equities. And Alicia, they did just that yesterday, which begs the question, and welcome to the program. Is this good or bad for markets?
Well, it's interesting. This is probably the first budget reconciliation bill that the bond market's actually paying attention to for the last 30 years or so. So, we were in a bond bull market for all that time. And with lower defense spending, and politicians were put on earth to give things away, and so anything that supported the economy and households lowering taxes, that was always positive for the economy. I think we've gotten to a place where you're running $2 trillion deficits over the last 5 years, and if you don't impose austerity, which has negative consequences for growth, you've gotten to the place where the bond market's now paying attention to the politics of this, and you've gotten to a place where now we're equities at 21 times forward earnings after that remarkable 23% recovery off the low, and you're in a place where equities are vulnerable here to what the bond market is telling us. I mean, there has been a disconnect in the conversation between the growth, the tariff conversation here, the earnings conversation on the one side with equities, and the fears in the bond market and the signals coming from the bond market this entire time.
There's a more constructive way to look at this. You could say that the passage of this bill, if we manage to extend the TCJA, the tax cuts from there, and if we manage to do just a little bit more, it could insulate this economy from the policy volatility of the last month regarding trade. Do you not take that view?
I do take the view, because ultimately most of our client portfolios are in equities, and for the most part that has always been the right place to be. So it's less about the tax bill itself and the effect of the taxes on growth. Yes, we want to avoid the negative fiscal drag of the $400 billion if this doesn't get through. The real issue is, I think, the deregulation and what's embedded in the bill, which is the immediate expensing of investment, the immediate expensing of CapEx and of building structures. That's actually very growth positive. I'll also say that the movement forward on AI is extraordinary. And so productivity gets the U.S. economy out of this kind of mess that we have, where it's very hard to impose austerity while at the same time keeping the deficit in control. Productivity can get us there. So what's embedded in the bill is getting us there. It's not the tax cuts per se. It's just the avoidance of a negative.
Do you think the bond market is more nervous about this bill altogether or tariffs? Because we saw a pushback already twice within Trump's first 100 days.
I think overall it's the message that there's a lack of political will to address the issue. I think that more than anything. It's not the bill per se, but it's the message that, imposing austerity to keep the bond market happy imposes negative growth consequences. And so there's no political will to do this at all.
If you're just tuning in, welcome to the programme. Bond yields are a little bit higher, up a single basis point on a 30-year, getting closer to 5.11%. Just moments ago, about 20 minutes ago, the House passing a revised tax bill. The one big, beautiful bill heads now to the Senate. Alicia, Levine of BNY is with us around the table. Also with us, Rob Casey of Signum. Rob, I said a surprise for some of us around the table. You weren't expecting this. How much of a win is this for Speaker Johnson?
I think it's a huge procedural win. And, Speaker Johnson has proven himself to be a really phenomenal speaker, right? Somebody who can bring his caucus, together around the things that he has to pass, sometimes overnight, frequently overnight. I think it's it's a very big procedural win. I'm not convinced it's an ideological win yet, right? I'm not convinced, as Annmarie has said, first of all, this is nowhere near what the final package is going to look like. And overnight, we also saw a number of changes that were on small things, right? Taxes on gun silencers and tanning beds, right? And to me, those things, as random as they sound in a tax package, they were to bring individual members on board, right? So it's not to say that there is a majority in the House of Republicans who believe in all of this. It's that there was a little horse trading overnight while some of us were sleeping. A lot in D.C. weren't. So I'm not convinced that it is the resounding win.
Whose district has a high concentration of tanning beds? Can we figure that out?
Mar-a-Lago, maybe, although they've got...
Florida, New York, New Jersey.
Yeah, they've got a lot more sun in Mar-a-Lago than we do in New York this week.
So the Senate is back June 2nd. How long for them to edit this and send it back to the House?
I still take the over. I think it probably, we wind up in mid-July, right? And then we're really talking about the debt ceiling and hitting the X date. It's still my expectation that they wind up pulling debt ceiling language out of the reconciliation package, passing it regular order. They force Democrats to vote for it, probably with very few concessions in the Senate, right? So then it's a bipartisan lifting of the debt ceiling. And we land in September, and we pass the one big beautiful bill X the debt ceiling, right? And as a matter of fact, we roll into Q4, and we could be talking about a fiscal year 26 reconciliation package. I don't think
it could leak into next year.
If they can't get it done by the August recess, I think the most salient deadline is the X date. And then it's September, and then it's the next fiscal year. And if they do it in January, right, nobody's paying 2026 taxes in January. So I do think that if not by July, which we don't think, there's not a great next deadline.
This is the challenge, Alicia, for a lot of people to take a 12-month view on this economy. What will the policy mix look like 12 months out? Will it be favourable to markets or not?
It's been fascinating to ask that question. I think overall it's positive because we actually upped our growth expectations for the year when it was clear that the administration's rolling back some of the more extreme tariff proposals. I think they got the message from markets that you've got to control this thing and you better start announcing some deals. You know, here's the outline of the deal. So I think it's positive for markets ultimately, but growth is going to be slower in the next 12 months. It's unavoidable. You probably have a slowdown at the end of the second quarter going into the third quarter here, simply because we've already had the shock. We've had the freezing in place plan. So, you know, we had the freezing. Some things are moving again. We see, you know, full container ships from China. That's great. But I think you just have this slow patch. Again, you know, if you're looking at a 1% economy, a 1.25% economy this year, you can still have positive returns in equity markets, but it's harder from here. And the vol is going to be there. The key thing is the stomach for the vol. That's what it's going to be living with us because we have the bond market now raising its objections to what's happening.
Speaker Johnson just done that news conference just moments ago. Steve Scalise speaking now. So let's head over to there and listen in.
Really important wins for the American people in this bill. And we had 11 committees come together and meet in hearings. Some went on over 24 hours. Rules Committee went over 20 hours. You had, you know, of course, the Budget Committee. Chairman Arrington is the lead author of the bill. All of the people that had to come together in our conference, and I think a lot of you know we don't all think alike. Democrats made it very clear they didn't want to have any part in helping get America back on track again, but we were never deterred. When this bill could have failed 10 times over, we said we were going to get this done and failure is not an option, and we meant it. We knew we were fighting for the families who've been struggling for way too long under the failed policies of Joe Biden and all the Democrats who did have control of Washington for too long. We watched higher interest rates and higher inflation and lower wages and a demise of the American dream that we knew should not be permanent, but was only going to turn around if we passed a bill to get America back on track. We knew we had to prevent a massive tax increase, so we put it in the bill. We knew we needed to secure America's border, as President Trump ran on all across this country and won the election on, and we put it in this bill. We ran on and said we would produce more American energy, and we put it in this bill. All the things that we knew we needed to do to root out waste, fraud, and abuse in government. Focus on those families who are struggling. All of that is in this one big, beautiful bill. And yes, now the House has come together and passed this bill against all odds, but we're still working on the rest of the process. It still goes to the Senate. The Senate has a lot of work to do too. That's why we've been talking to the Senate for a long time, but it's their turn to take this bill and move forward. But I'll tell you, none of this would be possible without the leadership of President Trump, who every step of the way not only laid out the vision, ran a campaign on this vision, but every step of the way too said, whatever you need, let me know. And he was there to help us. Our great speaker, Mike Johnson, who was never deterred, probably hasn't slept in a few days, but never wavered in his commitment to get this done. And this whole team has come together. And our whip has never relented and never stopped pushing to get this done. With that, I bring up our great Majority Whip, Tom Emmer.
Thank you, Steve. On November 5th, the American people rejected the failed policies of the Biden-Harris administration and overwhelmingly endorsed President Trump's America First agenda. Using his executive authority, President Trump hit the ground running on day one to deliver on the promises he made to the American people. Today, House Republicans followed suit. Our one big, beautiful bill fulfills the mandate for change we were given last November. It allows President Trump to continue his successful border security and deportation operations by investing in more Border Patrol agents and ICE officers, funding the continuation of the border wall, and equipping our men and women on the front lines with the tools they need to keep us safe. Not only will the one big, beautiful bill help to make America safe again, it will also help to make America wealthy again. America's economic revival has already begun under President Trump's leadership, but House Republicans back it up in this bill by making the 2017 Trump tax cuts permanent, eliminating tax on tips and overtime, and throwing out regulations that burden American businesses and suffocate American innovation. From promoting the safety and security of our great nation and giving much-needed tax relief to American families, to unleashing American energy and bringing accountability to important government programs, there are wins in this bill for every corner of America. Take this as a lesson. Don't bet against the House Republicans. We've shown time and time again that we deliver for the American people, especially when it matters most. By taking hold of this historic opportunity, I truly believe we've unlocked the opportunities for generations to come. And with that, I turn it over to our conference chair, Lisa McClain.
Thank you. Well, good morning, everybody, and a good morning it is. We just made history and passed the one big, beautiful bill, despite the Democrats' fear-mongering. Shocker, we haven't seen that lately, have we? And the hours that they spent stalling the votes on this entire process. The Democrats tried to derail this bill. And guess what? It didn't work. They failed. Not only did the Democrats vote against the bill, but they introduced hundreds of meaningless amendments, spewed misleading talking points, and now they have nothing to show for it, except voting on the record for the historic tax increase and to kill jobs of the small and medium class business owners in America. Frankly, Democrats voted to put Americans last, and it's a shame. But thank God for House Republicans, and thank God for our president, Donald J. Trump. His vision, alongside the work of my colleagues, made today a historic day. Behind me is what you see, a unified Republican conference with phenomenal leadership. And this Republican conference works as a team. This transformational legislation will provide safety and security for generations to come. Whether it's at our borders or in our pocketbooks, Americans will be better off thanks to the one big, beautiful bill. Our committees had difficult tasks, and they delivered. And some doubted that this was even possible. But at the end of the day, we all came together. House Republicans did not miss the moment. And because of our work, we will put more money in the pockets of hardworking Americans. We will prevent the next Lincoln Riley or Rachel Warren from being murdered. And we will save another family from the heartbreak of fentanyl poisoning. And to think the Democrats voted against all of that. But I am thankful for the House Republicans that they stood up for the American people. We put them first. This is what real leadership looks like. This is what winning looks like. And this is what America looks like under President Donald Trump and House Republicans' leadership. Safe, secure, and prosperous. And now I will turn it over to the chairman of the Transportation and Infrastructure, Mr. Sam Graves.
I'll be brief, but I'm proud to stand up here with my chairman colleagues, and I want to thank them for all the work that they did, the Republican leadership, and especially President Trump and his team for helping to get this across.
That's the latest on Capitol Hill. After the passage of the One Big Beautiful Bill leaves the House and heads to the Senate, I can tell you the bond market's got its say on things right now. Yields are higher by 2 basis points, the highest levels we've seen going back to 2007 on a 30-year maturity. 5.11 is the yield this morning. So that's what you're waking up to. We managed to pass the vote down in Washington, D.C. in the House. It makes its way to the Senate. It's likely to get kicked around a few times here, but ultimately we make some progress and the bond market's still pushing back.
Bond market pushing back, huge momentum for Republicans right now. And Jonathan, you quipped earlier, they're doing work before Wall Street even wakes up. It is 7:20 in the morning, and you have all these Republicans lining up saying how great of a job we did to get this bill. But guess what? This bill is not going to look the same when it goes to the Senate and then it comes back to the lower chamber.
If you're just tuning in, welcome to the program. Under surveillance this morning, Speaker Johnson delivering for the president.
On this vote, the yeas are 215, the nays are 214, with one answering present. The bill is passed.
So here's the latest this morning. The House passing President Trump's signature bill, sending it on to the Senate. Bloomberg's Tyler Kendall joins us now from Washington, D.C. That news conference ongoing, Tyler. What stood out for you?
Yeah, hey, John. Well, House Speaker Mike Johnson really did take his victory lap here, and he said, as I'm sure you heard, that he's hoping the Senate will consider this in a timely manner, as we know that he's already starting to court that upper chamber to not make many changes to this, even though it's already our understanding that they have a few items that they'd like to see on the chopping block. He also made sure to say that the goal right now is to still see the entire reconciliation package passed by July 4th. That's going to be important to this White House as they try to really wrap up this part of their economic agenda by, as House Speaker Mike Johnson said, Independence Day. Now, I note that as part of this deal, we did see a lot of these fiscal hawks end up getting on board. And it's our understanding that in a late night meeting with this White House, the administration did promise to work with these Republicans on future efforts, perhaps hinting at some executive orders that we could see down the line. So I would start looking out for sort of messaging and rhetoric around that in the coming days ahead to see if any of that ends up being part of the deals that are struck in order to keep this bill closely aligned with the House version once it gets to the Senate side. For example, after meeting with those House Republicans last night, we had President Trump refloating the idea of privatizing Freddie Mac and Fannie Mae, of course, something that has been previously brought up as a way to potentially help reduce the deficit. So things like that I would pay attention to here as they sort of start to carve out what this will look like ultimately in the Senate. And just lastly, John, I'd also mention this. I'm sure you picked up on it, but many of these Republicans during this press conference were also talking about the idea of how this will help to advance deregulation. Often we hear this administration talk about there are three economic prongs when it comes to tariffs, taxes, and then deregulation. I'd expect to hear the conversation start to sway a lot more towards that, too, in the coming weeks ahead.
Tyler Kendall in the nation's capital. That's the scene down in Washington. Here's the scene on Wall Street. Alicia Levine of BNY Wealth is still with us. Alicia, yields are pushing higher again by a couple of basis points. It's not too dramatic, the size of the move this morning, but the levels are getting our attention. 5.11 on a 30-year, the 10-year at 460. How problematic is that for equities?
Well, I think you saw it yesterday, right? That was the message. It's just going to be a struggle here. I think to the extent that yields stay above 4.5 on the 10-year, it's going to put a bit of a cap on where the market is. There's some technical levels, a little backfilling that we have to do because of the rapid V-shaped recovery we had from the bottom. So those are likely to get filled. But ultimately, you're sitting in a place now where we're looking at the labor market at 8:30 today, as we have every Thursday. We have the new claims data. That's the most coincident indicator that we have of what's happening in the labor market. So that's the next thing to look at. Does growth hold up here, right? Because the equity market has recovered remarkably well, even with the understanding, and I think the conversation is we're going to have a 10% universal tariff regardless. So that's already giving you about $200 billion in tariff revenue coming in. So that's a tax on the economy. So we've recovered from that. The next place is a grumpy consumer is still a consumer if that consumer has a job. The question is, do they still have a job? And that's really what's going to hold up the economy here. So far, so good. And I think defying all expectations thus far, the labor market's held up. So you can be grumpy, but if you have a job, you're still spending, right? Americans shop when they're unhappy as well as happy.
I'm pleased you mentioned jobless claims because we haven't talked about it yet. 8:30 Eastern time for jobless claims. Rob Casey of Signum, I just want to give you a final word. What you made of what you've seen so far this morning, and just articulate the next steps down in Washington from here.
So what we've seen this morning was a big success for Speaker Johnson, right? But as we've said around the table for the past hour, it is really only the first major step of a number to get to a final reconciliation package. It now goes to the Senate. The Senate has 38 legislative days between now and August 1st when they are supposed to go into recess. That includes Mondays and Fridays. The Senate's not working very hard on Mondays and Fridays usually, right? Today they were up early or up late. The Senate has to build essentially their own package, right? Because they can't just take this for what it is. Then it gets kicked back to the House. Republicans hope it gets on President Trump's desk in July. That is still a very heavy lift, despite what we've seen today, which is momentum, progress in the right direction for Republicans.
Rob Casey, Alicia Levine, thank you to the both of you. Progress in the wrong direction for the long end of the yield curve. 30-year yields higher by 3 basis points, 5.12 on a 30-year, a level we haven't been at since 2007. More on the passage of this bill down in Washington, D.C. in just a moment. Plus, we'll catch up with Eric Fisch of HSBC, with U.S. retailers wrestling with higher tariffs. From New York City this morning, good morning. You're watching Bloomberg TV. Here's the scene in Wall Street. Equity futures right now just about unchanged on the S&P 500 following 2 days of losses. Those 2 days of losses followed 6 days of gains, with a gain of more than 5% over that period on the S&P 500. This morning, just about unchanged, but in the bond market, we're making some moves. Look at the front end compared to the long end. At the front end, we're bid, yields are lower, but at the long end again, yields are climbing by 3 or 4 basis points, 512.75. Annmarie, a deal going through in Washington.
A deal going through in Washington on the House side, Jonathan. Now it goes to the Senate, and it's going to be changed in the Senate, especially when it comes to things like SALT and Medicaid. They're going to have their own version of how they want to edit this bill, and then it'll come back to the House. So this is the start of a very long process, but we should note this is a huge win for Speaker Johnson. He promised to vote before Memorial Day. He promised to land the plane, and he did that this morning.
And what it means this morning for the bond market is high yields. The highest yield we've seen on the long bond going back to 2007. That's the situation in fixed income. 2 hours away from the cash open. Let's get you some morning movers with Yahara. Hey, Yahara.
Hi, John. We start with the health insurers falling this morning after the Centers for Medicare and Medicaid Services said that it will audit all Medicare Advantage plans annually as part of a wider crackdown on improper payments. So as a result, we're seeing Humana shares down nearly 4%, while United Health, the nation's largest insurer, is falling 2.8%. But that stock just can't catch a break these days. Next up, we have Navitas. Those shares are skyrocketing, up 176% now on news that it's teaming up with NVIDIA, getting that NVIDIA glow as we've all come to know it. The two will develop technology that basically powers AI data centers more efficiently. Navitas says that the system will cut cooling costs while boosting power efficiency. Of course, all key for NVIDIA's GPU-heavy workloads. And staying on the technology sector, we do have Snowflake shares. Those are also rising nearly 10% now after the data warehousing company crushed expectations in its latest results. Hear this. They saw product revenue growth of 26%, hitting nearly $1 billion in the first quarter. And they see no signs of that slowing, with demand staying strong for its new AI tools. John?
Yahara, thank you. More from Yahara later this hour. On our radar this morning, our top story, the House passing President Trump's big, beautiful bill. The bill includes a $40,000 limit on the SALT deduction, speeds up work requirements for Medicaid, and puts an end to Biden-era clean energy tax breaks. It now heads to the Senate for their consideration.
Now heads to the Senate, where we're going to see changes in a lot of those provisions, Jonathan. Higher SALT deduction limit, that $40,000. Potentially that's a high watermark, and this is going to come down. There's not a lot of senators that are interested in increasing the SALT cap because there's no Republican senators from high tax states. Things like Medicaid. Potentially this is just too aggressive for some senators to sign up for. And those clean energy incentives from the Biden era, all those grants, a lot of those tax subsidies went to Republican states. So you have someone like Senator Tom Tillis. He doesn't want those to go away. He wants them to last as long as possible. So the Senate is going to make this a lot more moderate and then send it back to the House. And that is when Speaker Johnson's job gets incredibly difficult.
And this is the ultimate point of tension, and we've talked about it a million times. This is where the real challenge lands at the feet of the President of the United States to attempt to broker a deal. How do you please the Salt Caucus and the fiscal hawks in the Senate?
It's going to be very challenging because I really have a question this morning, seeing this vote count. What did the president promise the Freedom Caucus last night in the Oval Office that so many of them were willing to either vote present or vote yes, like Chip Roy, when it comes to this bill? It is going to be very challenging because he has to please a lot of different individuals and factions, but their margins are so slim. So everyone is going to get a little bit of something, but not everyone's going to get everything they want.
None of this is pleasing the bond market, particularly the 30-year bond. The JPMorgan Chase CEO, Jamie Dimon, saying the US faces stagflation risk thanks to geopolitical tensions, deficits and price pressures. Dimon adding he thinks the Fed is right to remain on hold. The 30-year yield this morning higher now by close to 4 basis points. We're basically closing in on 513 on that yield now.
And right now, Washington isn't exactly paying attention. I'm sure Jamie Dimon is. He says the economy is doing well. Effectively, we are in a soft landing, but does not tell you what the future will be. And he talked about huge deficits. He talked about the Fed hasn't finished quantitative tightening, and he talked about huge geopolitical issues. And all of this is why he's talking about this idea that he doesn't agree we're in a sweet spot and thinks potentially there could be these stagflationary fears.
Let's get to the higher prices. Nike raising prices on some of its products. Reuters reporting the hikes will begin next week. Prices for clothing and equipment set to increase between $2 and $10. Items between $100 and $150 will see a $5 hike. Shoes over $150 will see a $10 jump.
So once again, we have another company coming out and saying we are going to have to raise prices. How they talk about it, I don't think they mention trade tariffs or the president knowing squarely that if they do, they might get blasted by this White House. But obviously there's concerns with trade, especially given the fact that Nike has a lot of manufacturing in China. One thing I thought was very interesting and potentially an olive branch to this White House and the fact that they know that it is back to school. They're not raising prices on children's sneakers. That is a huge item for American families and parents when they're getting their kids ready for September.
Nike in the pre-market is higher by 1.5%. Let's stick with retail. Eric Fisch of HSBC writing, because of all the front loading on shipping, we don't totally know the true impact of tariffs yet, but the picture will become clearer as we get to the end of summer. Eric joins us now for more. Eric, good morning. It's good to see you.
Good morning. Thank you.
Just walk us through the state of play, just how things are, because it's really difficult for us, because of the front loading, to understand what is real, sustainable demand and what is just flattered by all of the front loading.
Yeah, I think that's a great question and something no one will be able to answer till we start seeing sales through summer, into fall, into back to school. I think what's important to differentiate is consumer sentiment from consumer spending. Consumer sentiment, all-time low, scary headlines. People keep spending. We're seeing that through the April numbers even, after Liberation Day. And so I think what's interesting is some of that sort of panic pre-buying? Maybe. But you generally don't go out and buy 5 pairs of jeans because you think prices are going to increase. That's more an iPhone story.
For economists out there, are you basically saying don't follow the University of Michigan consumer sentiment number, watch the labor market, watch jobless claims?
To me, jobs are paramount. People shop when they're comfortable in their employment, and regardless of savings almost, and then vice versa is true as well. When people are concerned about their job status, even if they have significant liquidity, they pull back on spending.
But right now, we do see in surveys, people are saying they are worried about the labor market.
Yeah.
But spending continues.
But continue to spend. And that's not dissimilar from what happened during COVID. People were genuinely terrified, but continued to shop.
I'd love to get your take on how these retailers talk about prices going up. They're taking different tacks, and it sounds like they are nervous about retribution from this White House. How do you view this situation right now between Washington and the C-suite?
Yeah, I speak to retailers, wholesalers, manufacturers. Everyone is trying to manage the process and share the pain. So we are seeing a split. We're seeing people on the factory side and then the wholesale side absorb some of the price increases. I think it really is different price point by price point. If you're selling a $300 sweater and it goes to $350 in the fall, that customer is not super price sensitive. If you're selling a $9.99 item and it goes to $11.99, That's a significant difference in demand. So price point by price point, it differs.
So when the president says eat the cost, who is eating most of the cost?
Yeah, it really ends up being almost a third, a third, a third. The shopper is a third, the retailer is a third, and then the factory is a third. Now, for that low price point, people are trying to trade off some margin to hold the volume, because as you raise prices, it's a pretty precipitous drop in demand.
What did that split that you just described look like back in 2022? What did it look like coming out of the pandemic?
Yeah, I would say it was much more on the factory side. When it was a smaller increment of tariffs, people were able to put pressure on the factory to absorb more of it. This is a more significant amount, and so people are sharing it.
I just meant in terms of consumer confidence and the ability to really pass this on to the end consumer. Do you think there was a lot more confidence to sit there and say, you know what, consumer can eat this, let's pass it on? Have things changed in the last few years on that front?
Yeah, I think that's fair. Demand was strong then, and so to the extent that prices went up, we didn't see a significant change in consumer demand. I think shoppers have really shifted more dollars. First of all, everything costs more. More dollars have shifted to items other than discretionary consumer products. And so when you're chasing fewer dollars, you have to be more careful.
Seems to be what's hurting Target right now. That shift from discretionary to necessities.
Yeah.
Who's in the sweet spot? If there can be a sweet spot in a moment like this one, who's in it?
Good brands, good products. That will always win over the consumer. So if you're on trend, if you have the right product, you are more insulated from price changes.
But which retailer is in the sweet spot?
I'm not going to name a specific retailer. Many of them are my clients, but you look at things that are on trend, that have high demand, that are.
But is it fair to say if you're bigger, you can withstand all of these challenges right now?
Yeah, absolutely. Size matters, but I would say at both ends of the spectrum. So if you're small and nimble, we've seen the same thing with our clients, where you can shift. If your production process is more streamlined, you can shift that production to another country a lot faster than a massive organization.
Target talked yesterday about improving agility, and I think some of that speaks to what you're talking about. Eric, thanks for dropping by. Fantastic to catch up. Eric Fisch there of HSBC, and what's happening with the retailers at the moment. We need to talk to you about what's happening in the bond market at the moment off the back of the passage of the bill down at the House in Washington, D.C. Yields are higher by 3 basis points, 5.12. It's been a theme of this programme so far this morning, Washington versus Wall Street. Fact of the matter is, for a lot of people, very engaged with the people that operate down in Washington, D.C., what happens on Wall Street, they don't pay a ton of attention to until they really have to. And apparently 5.12 is not the number that gets that done.
That's definitely not the number that gets that done, not this morning. And we need to remind our viewers that this is the first step of a very long hurdle when it comes to the 1.3b, the one big beautiful bill. It's going to go to the Senate and it's going to get moderated. There's going to be a number of changes across the board, clean energy incentives, the SALT deduction, things like Medicaid. It's going to be almost sanitized in the Senate, and then it's going to come back to the House. And that's when the fight really begins.
Bond yields just a little bit higher, equities a little bit lower, just turning negative on the S&P 500 after being positive by about 1/10 or 0.2%. Let's give you an update on stories elsewhere this morning with your Bloomberg brief. Let's cross over to Yahara. Hey, Yahara.
Hi, John. Well, recapping what's happening in Washington, the House narrowly passing President Trump's one big beautiful bill by a vote of 215 to 214. The bill now moves to the Senate, where debate will begin on June 2nd. The upper chamber will make changes to the bill before sending it back to the House. Speaker Johnson hopes to deliver the bill to the president's desk by July 4th. Meanwhile, a rally in Bitcoin, the original cryptocurrency, topping $111,000 at one point earlier. The latest milestone comes as President Trump prepares to meet with the biggest holders of his meme coin at a dinner tonight at his golf club just outside Washington. Bitcoin is up 18% so far in 2025. And in sports, Game 1 of the NBA's Eastern Conference Finals was one to remember after the Pacers came back to beat the Knicks at Madison Square Garden. The Knicks were up 14 points with less than 3 minutes to go in the fourth quarter, but the Pacers stormed back and tied the game on a wild buzzer-beating shot from Tyrese Halliburton. Indiana held on to win in overtime, 138 to 135. Ouch. That's your Bloomberg brief. John?
Yahara, thank you. More from Yahara in the next hour. Up next on the programme, Jamie Dimon, unfazed by the bond market.
How high do yields have to go before they reach breaking point?
Yeah. I don't know the answer to that. I don't worry about one-day move in bond markets. I just think there's a chance that you'll have stagflation.
Up next on the programme, we'll catch up with Greg Peters of PGIM as bond yields at the long end of the curve go through levels we have not seen since 2007.
Desk by July 4th, and that's a big thing. The reason we were so aggressive, and I know some of y'all smiled and probably mocked me a little bit when I said early on we were going to do this by Memorial Day. You didn't believe it. I know you didn't, Reese. Most of you didn't. But the reason we did that was not because out of pride of authorship or because we were trying to, raise some banner. We did it because we need to get this relief to the American people as soon as possible. And President Trump made these promises on the campaign trail, and we did as well. And we wanted, as Jim Jordan likes to say, we're going to do what we said we were going to do, and that's what this bill represents. And so the timetable is important. We also have the debt ceiling approaching. We've got the relief that the people need, and the sooner they feel that relief, the better. So we did our job, rolled up our sleeves, got it done, and we're really proud of that effort. One more question. Yes, ma'am.
Is there anything that the Senate might be considering in terms of changing this bill that you all will not accept?
I'm not going to draw any red lines. Look, I told them there's a lot of different opinions over there as there is here. They have a small margin as we do. We had a 3-vote margin. By the way, I just want you to know for the record, we really had 217 votes this morning. Andrew Garbarino did not make it in time. He fell asleep in the back. No kidding. I know. I'm going to just strangle him. But but he's my dear friend. And then David Schweikert was going to vote and slipped his card in right at the last minute. So it looks like a razor-thin margin, 215 to 214 and one present. It was really 217, okay? Will y'all put a footnote somewhere in history on that thing? They're both going to go on record saying that's how they would have voted if they got the card in time. Thank you so much for being here. Bless you all. Thanks all these guys. Thank you.
Speaker Johnson wearing a big smile this morning from New York City this morning. Good morning. To those of you just tuning in, Speaker Johnson up all night, and this bill passing the House, making its way to the Senate for their consideration. The one big beautiful bill advances in Washington, D.C., and this is what it does on Wall Street. Equity futures just turning a little bit lower. I won't make too much of this, but at the long end of the curve, that move continues. Bond yields at the long end higher by a few basis points, call it 3 or 4. We're at levels we haven't seen since 2007, 512.86.
The bond market is looking at this and looking at the trillions of dollars this is going to add to the deficit. This is a huge win, though, for House Republicans. Speaker Johnson there, though, I think the most interesting line was, I'm not going to draw any red lines when it comes to what's going to happen in the Senate, because he knows very well, especially given the conversations he's had with the president and senators and Majority Leader Thune, that this bill is going to get changed.
Greg Peters of PGIM Fixed Income is with us in the studio. Just a perfect guest to talk about what's happening in the bond market. Greg, good morning.
Good morning.
What do you make of these moves to the long end of the curve? I don't want to make this too much of a big deal if it doesn't have to be. We have sustained levels around 4 to 5% for quite a number of years now, and the economy's been OK. What does 512, 513 mean to you on a 30-year?
I think it's the direction, right, not the level. And so there is just a pushback globally on the back end of the curves. So if you look at what's happening in Europe, you're looking at Japan, obviously the U.S., investors are basically having a timeout on the back end. And so consequently, you're just seeing the 30-year, 20-year yesterday really trade heavy just because there's not that investor demand. I think investors' concerns are manifesting itself in term premium and kind of wait-and-see mode in the back end of the curve. And that makes sense to me.
Can you help us understand the things we should care about and the things we should ignore? Typically, a 20-year maturity isn't something that investors like anyway, and it's auctions that we don't typically follow. All of a sudden yesterday, 20-year auction, soft demand, and everybody cared about it. And I sat there and I just thought, if you care about 20-year auctions, you have no place in the bond market. What did you make of how much weight people put on that?
Well, so the 20-year definitely is an orphan type of, maturity bucket. But what it says is about the duration. So forget about a 20-year, 30-year. It is adding duration to the portfolio. So that's where the pushback is. And 20 years are trading poorly everywhere as well. So it is an anti-duration trade. And what you're seeing in the back end curves globally is that they're behaving like risk assets not like the typical kind of defensive risk-adverse assets. And that just kind of feeds upon itself, which is why you have two separate bond markets. In the front end, you have yields and prices driven by central bank policy. And as you move further out, it's driven by all these other factors, from debt and deficits to inflation to the uncertainty to all these
Greg,
factors.
what you're saying is so important. If we've diluted the risk mitigation characteristics of the long bond, what does that mean for how people invest? And what are you telling clients of PGIM that they should do?
Yeah, it makes it really tricky. And what you're seeing is kind of manifold. First, you're seeing just investors kind of diversify globally. So you're seeing less of a sole focus on the U.S. bond market. So you're seeing in gilts, you're seeing in JGBs, you're seeing it across, just to get that diversification in. And then, second is front in the curve, right? You want to be attached to something that you think you have a better understanding, and that is the central bank reaction function. So in our minds, you want to be as close to that kind of 2-year front end point as you can. The further you drift out, the more vagaries you introduce into your portfolio. So to get defensive, I think, is to kind of stay front end. And that includes spread and carry as well. So we're very defensive. We think valuations are exceedingly expensive. I mean, you just kind of think about it in really simple terms. Credit spreads are well through kind of the average, and I think all of us would admit it's probably above average uncertainty out there and risk. And so just kind of think of it in that simple way, and you want to be defensive.
And that uncertainty is emanating from Washington, D.C. Can we talk about that relationship? Is there a line you think that Congress actually starts paying attention to?
It has to get worse. So the only arbiter out here right now is the bond market. So it's kind of back to the 90s, right? Kind of Carville's revenge. And so absent that, there's no political will. You saw this bill last night. It was cats and dogs and all these things. No one wanted to cut, and all these things were added. It's not the political will of Congress to kind of tighten the belt. And what you're seeing from a market perspective is really worrisome outlook on the debt and deficit. And quite frankly, it is worrisome. It is a really bad place, right? We never took our deficit to a better place when the economy was doing well. And so what I really worry about is not the here and now, but let's say when and if we do enter a recession, then what? There's one or two options. One is Congress doesn't do anything fiscally, which means you have a longer, harder recession. Or they do as they always do, they spend, and then you come out the other side, and the debt and deficit is exceedingly worse, and then you put us in a real precarious position.
$1 trillion question. Can I just jump in quickly? Forgive me. What you just said is so important. Typically in developed markets, what happens is you go into a downturn, yields drop, and it enables fiscal authorities to act counter-cyclically.
Yeah.
This is also important to investors because they understand that's the ballast in their portfolio. You get into bad times and bonds rally. That is the definition, for me at least, of a developed market. That's what happens in DM. In EM, you have problems, other things happen. Are you suggesting that if we go down into a downturn and the deficit, just by definition, blows out, that yields don't drop, that they actually might climb?
There's that potential. I think it's a level of uncertainty that is introduced that we typically don't have to worry about, right? And just the fact that we're having that conversation and that question just changes behavior. So, what we saw in 2021, 2022, when inflation moves higher, as an example, there's nowhere to hide, right? So this is a kind of a similar story in a way. So that's the worry. It's not my base case, by the way. I don't want to
Sure.
be all dark and dour here, but at the same time, that is a real risk that investors face.
This is just a really important thought exercise that I think is happening on investor committees around the world right now. I just wanted to finish with the level that we're at the moment. So 5.14 now almost on a 30-year yield. When I started the conversation, I talked about somewhere between 4 and 5. We have lived with that through this cycle so far. But when you get to the upper end of where the range is for the whole cycle, which is basically through that level right now, life up here hasn't been sustainable. Is this self-limiting? How sustainable are these levels?
I think to a degree it is. So I do believe there'll be a crowding out effect, so to speak. So if you continue to move yields higher, that just changes the incentive structure, right? So investors are much more apt or willing to invest in treasuries, let's say, vis-a-vis investment-grade corporates and equities. And so there is this great kind of modulator, regulator function with yields itself. But at the end of the day, you have to have a higher level of certainty of what you're investing in. And so, yes, as yields go higher, that compensates you more for that uncertainty.
Yeah.
But typically, you don't see investors jump in when they don't know what they're jumping into.
They're not jumping in right now, that's for sure. Greg, appreciate your time, as always, sir. Thank you. Greg Pettis there of PGIM. Up next on the programme, we'll catch up with Scott Chronert of Citi, John Lovallo of UBS, Nela Richardson of ADP, and a whole lot more.
Our political system is showing absolutely no signs of slowing down the borrowing, and this is going to continue to rattle bond market holders.
What the bond market is worried about is that over the longer term, it will increase the deficit.
Congress is not doing its bit, so the bond market has to force Congress to do its bit. And so I think that's why the long end is scary.
The number one risk right here and now is that long-term bond term premium.
We could have a debt crisis scare.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
What a morning already. Live from New York City this morning. Good morning to you all. The third hour of Bloomberg Surveillance starts right now, and your scores look like this. The game is between Washington and Wall Street. The House passes its bill onto the Senate, and Wall Street pushes back. Equities are down by 0.4%, but check out the bond market. This is the move. It's the move in the long end of the curve. The 30-year yield higher by more than 4 basis points, call it 5. The yield this morning, 5.14, a level that we haven't spent much time at, if at all, since 2007.
Well, Jonathan, Wall Street's pushing back. Is anyone in Washington listening? They're not. They just voted on this bill. But we really need to talk about the fact that this is the start of a very long process. There are reports that the speaker's now going to get on the phone with the president. Clearly, they're going to be excited. They delivered. But it's going to be an uphill battle. I think the most important line that came out of after this vote was Speaker Johnson saying, I don't have any red lines, because he knows that he is going to have to do a lot of gymnastics with his caucus to try to get them to vote again once the Senate makes massive changes to all these negotiations he just spent the whole week inking.
Let's go through the timeline and then frame the problem. So here's the timeline. Get it passed through the House by Memorial Day. Done. Get the whole thing signed, sealed, delivered by Independence Day, July 4th. Here's the challenge. The challenge is trying to satisfy the SALT caucus in the House at the same time you satisfy the fiscal hawks in the Senate. How are they going to achieve that in the next several weeks?
It's going to be very challenging, and there's going to have to be, as Rob Casey said, some individual levers being pulled, provisions put in the bill just to get a single individual to vote. I think SALT is going to be the hardest for the Senate. There is not a single Republican senator from a high-tax state like New York. There is no impetus for any of these senators to say, yeah, I'm willing to vote for a bigger SALT cap. It's going to be very challenging. So this is where President Trump is going to have to get involved when it comes to this negotiation between the lower and the upper chamber.
There's a lot of self-importance on Wall Street. I get it. You make the world go round. I'm right there with you. Yields are higher by 5 basis points this morning, 5.14. The feeling I get, though, from you and other people that spend a lot of time in Washington speaking to these people is that these moves don't really matter that much to these people down in Washington, D.C., and I think you saw that playing out quite clearly this morning.
It was just convenient for a lot of these individuals yesterday that have been going on for their entire career, that the fiscal health of the United States is on a trajectory that's going downward. So individuals like Chip Roy, they're coming out and saying, noted, I see what's going on in the bond market. Look, yields are pushing back on our one big beautiful bill. But no one in Congress really cares. They want to get this bill across the finish line. There are two people in Washington who do care, though, about the long end of the yield curve. And that's the President of the United States. And we saw him reverse his tariff policy when the bond market was, quote, his words, yippee. And also the Treasury Secretary. He sat around this table and told us that he cares about the 10-year yield.
The 10-year yield this morning, 4.62. Coming up this hour, Scott Chronert of Citi. As risk appetite on Wall Street fades, we'll catch up with John Lovallo of UBS as home builders signal resilience in the face of higher rates, and Nisha Patel of Parametric reacting to the latest economic data. We begin this hour with the House passing President Trump's signature bill, sending it on to the Senate.
On this vote, the yeas are 215, the nays are 214. with one answering present. The bill is passed.
Joining us now from the nation's capital, Bloomberg's Tyler Kendo. Tyler, the bill is passed. What next?
Yeah, hey, John. Well, it was interesting to get some color from House Speaker Mike Johnson there afterwards when he took some questions from reporters, saying that there were a few different moments during this past week where he thought the whole thing was going to fall apart. So we do know, of course, that he had to really do some of these big deals behind the scenes, and that's going to have to happen again when this bill moves over to the Senate. He then was also asked if he's concerned about whether or not the Senate's going to completely change this legislation, since we know there are a few items here that are definitely up to be potentially on the chopping block or changed altogether. And he said that ultimately he is already starting to make his case to senators that there is a delicate equilibrium, as he called it, just to get this through the House, and that they need to recognize that ultimately at the end of the day they're going to have to work with the lower chamber to get the entire reconciliation package done. John, of course, there's a few different pressure points here that are going to come into the picture when it comes to getting the Senate to move on this. One, of course, is the White House, but the other is that X date and whether or not Republicans can get this done by August, which is where we're currently seeing those estimates land, as the White House wants it done even before that, by July 4th.
Tyler, how likely is July 4th, honestly?
We're going to have to wait and see, Annmarie. Of course, we didn't really think that this Memorial Day deadline was considered to be pretty ambitious. So at the end of the day, it's going to definitely take some more of these deals. What that will look like, we're going to have to wait. Of course, we know that likely there will be changes to how House Republicans have currently implemented those work requirements going into effect perhaps ahead of schedule, now slated for December of 2026. Also watch out for how those IRA tax credits when it comes to clean energy end up getting rolled back. We know that many senators here have already expressed concerns about rolling them back quickly, since some of these companies are already banking on using them. And then the SALT cap, will that really remain at $40,000? We're going to have to see what sort of deal is worked out there, because at the end of the day, it does need to agree in both of these chambers if President Trump wants to see the one big beautiful bill fully realized.
Tyler Kendo down in Washington. Tyler, thank you. The latest developments in the nation's capital. The latest developments here on Wall Street, yields up by 4 basis points. The 30-year, 5.14. It's just a bit of a perfect storm. Typically, we wouldn't talk about a 20-year auction. That 20-year maturity, as we heard from PGIM and Greg Peters, a bit of an orphan on the yield curve. If you just look at how it sticks out, a bit like a sore thumb. People don't really like it anyway. But the fact that people were concerned by that yesterday, you add in maybe the hot inflation in the UK, you add in the issues that we had in Japan, you add in the bill that's gone through Washington, D.C. this morning. It's all of that. It's a global story, not just a domestic one.
Yeah, Neil Dutta actually pushed back on me on this yesterday. We were chatting, and he said, look, this isn't idiosyncratic what's going on in the United States. Look what's going on globally. But what is happening is in the United States is we saw the bond market push back on Trump's tariff policies. We saw him reverse. Now we're talking about, when you look at CBO scoring, you look at Penn Wharton scoring, we're talking about trillions of dollars, north of $3 trillion over 10 years being added to the deficit. And the bond market's saying you are not doing enough to control spending, and they are pushing back. I thought what was so interesting about Greg Peters is he's talking about this direction of travel, where things are going. Because I think the bond market's smart enough to know that this bill that was just passed is not going to be the end destination for this specific one big beautiful bill. But it's the direction of travel where the fiscal health of the United States is headed.
Equities down this morning by about 1/3 of 1%. This is the view on Wall Street from Scott Chronert of Citi, writing the following. Recent signs of consumer slowing are concerning. We bias in favour of a combination of defensive names and secular growers that have been more heavily investing in their businesses. Scott joins us now for more. Scott, welcome to the programme, sir. We need to take a bit of a beat and talk about what's developing in the bond market and what ultimately it means to you and the team in equities, Scott. What happens when we get to these kind of levels in bonds? What does it mean to you?
Jonathan, well, it means a couple of things. I think first and foremost, you look at the potential impact of higher rates in terms of a slowing effect in terms of demand for new credit. That's pretty straightforward. Additionally, from an equity perspective, it's mostly about valuations. And essentially, when you're looking at how to value securities, it's a combination of where you think near-term fundamentals are going, but it's also how you discount future earnings 5-10 years down the road and assign a valuation to terminal values. And so what ends up happening here is when you back up yields, you begin to change the math, and those future earnings are worth less now. So the bottom line is that from a valuation impact, when you look at this current trajectory in 10 years in particular, where we focus, It's a gating factor potentially on future economic activity, but essentially real time, it's an overhang in terms of the valuation setup for U.S. equities.
When you look at the policy down in Washington, Scott, we do have the one big beautiful bill passing through on the House side, and the bond market seems to be pushing back on a number of issues. But what if they didn't do anything and we would have a tax hike at the end of the year? What would the bond market do then?
It's kind of pick your poison, right? So what you would get with the tax hike, which was where we were a year ago at this time looking at potential presidential election outcomes, is that you would have a different influence where you would probably begin to slow aggregate spending levels. You would crowd out essentially expenditures because more of your income is going to taxation. So essentially, it's a be careful what you wish for. The bottom line, Annmarie, is that we've been living in a fairly fiscally stimulative environment going back to the pandemic. That's when you really began to see your debt to GDP rise. And now with the Fed rate policy in the rearview mirror, you're also looking at the debt service component kick in as well. So essentially, from my perch, from an equity perspective, you get the deficit spending. That's fiscally stimulative. That's actually pretty good for economic activity and probably for corporate fundamentals. But the offset is what you're doing in terms of paying forward now for future pain in terms of the risk of higher for longer rates, the valuation impact, and the ultimate slowing effect that can have on economic activity.
So, Scott, as you know, the economists over at Citi, your colleagues, are worried about a downturn, a hit to the labour market, and they think we're going to see a real reduction in interest rates. I can tell you in fixed income, the conversations we keep hearing is that they don't know what defence really looks like anymore, and they don't want to play out on the long end of the curve. They want to aggressively shorten duration. Scott, how does that apply to equities? How are you thinking about defence now compared to maybe years gone past?
You know, Jonathan, we pulled out, a month or so ago, in old playbook, a tactic of ours, where when you go into these periods of economic concern, we like to pull out growth as defensive as our approach here. And so what I'm getting at is that you're dealing with lots of issues in terms of economic activity that affect the way you think about traditional cyclical parts of the market and also traditional defensive parts of the market. However, when you look at longer term, where are the best underlying structural growth dynamics at work? There's still the AI play here, but you can broaden it across sectors. We've been writing more recently within the consumer discretionary sector as an example. But my point here is that one antidote to a lot of the issues that we're discussing right now in terms of rates, economic activity, deficit, is show me the growth, where I've got more confidence in longer term structural growth drivers at a company specific up to a sector, maybe even market level. That, in our view, is the more appropriate way for navigating the current period of uncertainty that we've got from a fiscal and economic perspective.
Scott, when you screen for those things, does it scream Mag 7?
It has to start there, because where you go with this, Jonathan, is let's look at where companies are spending. Capital spending, for the most part, is very concentrated within the S&P. The mega cap growers that are attached to the AI trend are certainly driving the bus right now. And what we saw with Q1 earnings is that there's not much of a risk to that materially changing in the short term. However, when you look across sectors, again, I mentioned consumer discretionary, you can find companies that are showing capital expenditure profiles well above depreciation, where their fundamentals are also less cyclical, and the correlation of their fundamentals is less tied to economic activity. Those are the types of names that we want to keep a focus on. And I think that's an appropriate way for thinking about the valuation issue we have with broader equities, as well as how to think about navigating this current macro setup, which certainly is noisy at the very least.
Scott, when you put consumer discretionary and you break it up, how much performance dispersion are you seeing within that group of stocks at the moment?
There's a lot, because at the same time, consumer discretionary and staples right alongside, that's ground zero for where tariff effects are kicking in, particularly as it relates to the China aspect on this. So what we've seen through the tariff discussion over the past several months is a very strong dichotomy in performance within the consumer part of the market, where you got companies that are more directly exposed to China feeling the real brunt of that. But again, I'd come back here. It's less about the inflationary component of tariffs. It's more about the gross margin pressure that potentially emanates from your, higher cost of goods that you're importing. So bottom line is that there's a lot of performance dispersion. And so we're kind of cutting through all that noise with let's keep a focus on companies that we think structurally are in a pretty good position to perpetuate ongoing growth, again, regardless of the macro circumstance right now.
Scott, appreciate your input. As always, what a morning already. Scott Chronert there of Citi breaking down the equity market for you. As this bond market breaks down a little bit, yields up by 5 basis points on a 30-year. We're looking at 5.15 now at the long end of the curve.
And you wonder who in Washington, D.C. is actually running a bond board right now, besides maybe the Treasury Secretary and the President of the United States, who we do know the bond market reacted negatively with yields rising. When it comes to his tariff plan, he reversed course. They're not going to reverse course on this bill, but what this bill will do is it will become more moderate in the Senate. So that SALT cap might not be as high. Those Medicaid cuts actually might be pushed out, or the work requirements might start later on in a few years, not in 2026. So this is the start of a very long process, but I don't really think anyone in Washington, D.C. is paying attention.
Some of these issues are why a lot of investors have thought about aggressively shortening duration, and why many guests on this program over the last several weeks have talked about the so-called belly of the curve. They like the 5-year. The 5-year is rallying this morning. Yields are down by 2 basis points, and you've got this curve steepening taking place where the front end, the yield is dropping, and the long end is selling off. The yield is climbing. And the difference between the two now, 5s and 30s, is through 100 basis points. They're the moves on the screen this morning. Let's get you some stories elsewhere with your Bloomberg Brief. Here's Yahira. Hey, Yahira.
Hi, John, and it's because of this, the House narrowly passing President Trump's one big, beautiful bill by a vote of 215 to 214. The bill now moves to the Senate, where debate will begin on June 2nd. The upper chamber will make changes to the bill before sending it back to the House. Speaker Johnson hopes to deliver the bill to the president's desk by July 4th. Meanwhile, Disney is suspending Venezuelan workers following the Supreme Court's ruling that allowed the Trump administration to revoke protections for 350,000 Venezuelans. Disney notified its Florida-based employees who are losing temporary legal residency that their jobs would be terminated next month. The company said about 45 workers are affected. And OpenAI is buying the device startup co-founded by Apple veteran Johnny Ive in an all-stock deal worth nearly $6.5 billion. Ive and OpenAI CEO Sam Altman will work together to create new devices around artificial intelligence, with their first product expected next year. That's your Bloomberg Brief. John?
Yahira, thank you. Appreciate it. Equities making new lows here as this bond market yields make new highs. Up next on the program, the morning calls, plus John Lovallo of UBS as home builders signal resilience in the face of higher rates. Live from New York City this morning. Good morning. Washington loves a long weekend. Don't they love a long weekend? That was the incentive to get this done before Memorial Day. Speaker Johnson did exactly what he said he would do, passing this bill by Memorial Day with days to spare. It's on to the Senate for their consideration. Equity futures on the S&P 500 negative by 0.5%. On the Nasdaq down by a similar amount. On the Russell down by more. We're down there, softer by 1 full percentage point. It's the bond market that gets your attention again today. Check out the front end, compare it to the long end. Yields lower at the front end by 3 basis points to break a 4%, and we add some weight to the long end again. The 30-year down, yields up by 5 basis points, 5.14.15. We'll come back to that in just a moment. That's the price action. Let's get you some morning calls. First up, Bank of America downgrading target to neutral, citing the company's uncertain outlook. That name is down by 1%. Your second call from JPMorgan, upgrading Urban Outfitters to overweight, pointing to positive sales growth across brands. That stock is flying by 17%. And finally, Wells Fargo raising its price target on Toll Brothers to 130, expecting outperformance following better than expected earnings. That name is down just a touch by 1%. Let's stick with Toll Brothers, the company maintaining its 2025 outlook, citing resilience among its affluent buyers. John Lovallo of UBS reiterating his buy rating and 183 price target, saying we remain positive on shares given the company's consistent execution. John joins us now for more. John, welcome to the program, sir. Before we get to the stock-specific stuff, I just want to talk about the broader story for the home builders right now and what a 30-year of 514-ish means for the industry you cover.
That's a great question, John. Thanks for having me. Look, I think it's important to understand that the 30-year fixed rate mortgage is at around 7% right now, maybe slightly above. The builders have executed at levels well above this. And I think that it just demonstrates the changed business models and the ability to really navigate tougher environments. Now, look, if we take a broad step back and just look at sales this year, we're up slightly on a new home sales basis, but it's been driven by incentives. Keep in mind, an average incentive for a home builder is about 3% of the sale price of a home. We're up around 8 or 9%. So the builders are offering a lot to get these sales across the line. Now, because sales have been a little weaker, the builders have done the rational thing and have pulled back on starts. And this is very synonymous with this new business model that they have, where they're much more diligent about how they're kind of putting inventory into the market. Now, importantly, this pullback in starts has allowed them to maintain margin and maintain some pricing. Now, keep in mind that intent to buy is still very strong in the U.S. Our recent survey, Global Housing Intention Survey, which is the longest standing on the street at UBS, signaled that 32% of respondents intend to buy a house over the next 12 months. That compares to the long-term average of 30%, the pre-COVID average of 25%. So intent and desire is not the issue. It's just getting affordability right.
Well, the CEO of Toll Brothers said that they believe the long-term outlook for the new home market remains positive. How is it so positive if yields remain so high?
Hey, Annmarie, I think it comes down to a couple things. One, underlying demand, as I mentioned, and intent is still very strong. There's a very strong wave of first-time buyers coming through the market right now that are reaching prime home buying age. This is a good example of the millennial generation. They've done things a little bit later in life. They're better financed. And oh, by the way, they're receiving part of this $64 trillion of generational wealth transfer from the baby boomers to help with down payments. 25% have said that they're receiving down payment assistance. And so as these folks have life events like getting married, having children, it necessitates more space. And this is really, really driving strong underlying demand for housing and will continue to over the next 5 to 6 years.
John, I'm sure you can break down the numbers to some degree. Toll Brothers, that's a super affluent customer base. How many of those are borrowing money? How many of those are paying cash?
It's a good question, John. Look, I think a couple things with Toll Brothers. They do have an average selling price of $1 million, that's for sure. But they span a wide spectrum. They go from $300,000 up to $5 million. So they do have a pretty good broad spectrum across the group. About 25% of their buyers pay all cash. The rest are getting some kind of financing. But look, it is a more affluent buyer for sure. Even at the first-time level, I would tell you that their first-time homes are generally around $500,000.
Out of all the names you cover, John, who do you think is most exposed to this rate story? Which is the company that you're less constructive on?
From the home builder space specifically, we're pretty constructive across the board. We favor, to answer your question, still, believe it or not, the entry-level players. Now, we do take a bit of a barbell approach where we like Toll at the high end, but the entry-level players are bringing product to the market that is affordable. Keep in mind, the median home price in the U.S. for existing homes is $408,000. That's above the median new home price, which is $402,000. And then you get a company like D.R. Horton or Meritage, for instance, that are bringing new homes to the market at $30,000 below that price, and that's compelling. And if you can couple that price with, a mortgage rate buy down, all of a sudden the wheel starts turning and you can get more folks qualified for homes.
Hey, John, appreciate your time. As always, sir. John Lovallo there of UBS on the home builders. The home builders in focus for obvious reasons with this move in the bond market. The move in the bond market off the back of the passage of the bill down in Washington, D.C. through the House. Hearing from the president right now, the one big, beautiful bill has passed the House of Representatives. He goes on to say, now it's time for our friends in the United States Senate to get to work and send this bill to my desk as soon as possible.
He says there's no time to waste, but this is where the president is going to have to do a lot more work on Capitol Hill in the upper chamber and the lower chamber, trying to converge all these factions to get to yes at the end of the day. This is the start of a very long process. There's a lot of senators that do not like what's currently in this bill.
It's amazing how happy Washington is this morning. For good reason. They're passing this on time. This was an objective they campaigned on. But then at the same time, just this nagging feeling that the bond market's got something to say about it. 30-year yields up by 6 basis points, 5.15. Up next, some data. Jobless claims just around the corner. We've got a really interesting session coming together down in Washington, D.C. They've been up all night. That bill has passed, the one big, beautiful bill, making its way to the Senate for consideration. And this equity market is speaking loud and clear. Equities near session lows. On the S&P, we're down by 0.5%. On the Russell, that's where your underperformance is, negative by 1.2%. In the bond market, check out this move. At the front end, a rally, yields down 3 basis points. At the long end, a sell-off, yields up 5 basis points. 5.15, a level we haven't seen since July 2007. And this Congress, Annmarie, didn't blink.
Didn't blink at all. They passed this beautiful bill along. The President of the United States is celebrating right now on Truth Social. The most important line, though, in here is now it's time for our friends in the U.S. Senate to get to work, get it to my desk as soon as possible. This is the start of a very long process, and this bill is not going to look the same when it comes back to the House after the Senate does their tweaks.
We've got to talk about some economic data, so let's look at jobless claims, initial jobless claims, together with continuing claims. Jobless claims coming at 227. The estimate was 230. The previous week was 229. Continuing claims rise a little bit, the wrong kind of upside surprise, but jobless claims at 227. This is where the debate down in Washington is interesting to me. We're running a budget deficit of 6% of GDP, with jobless claims still very close to historical lows at 230. Unemployment still around 4%. By definition, at the headline level, and I know there's a lot of bifurcation beneath the numbers, but at the headline level, these are good times. Supposed good times, and we're running monster deficits in Washington.
Absolutely. And people say during the good times, which you're seeing right now, potentially, this is when they should be working on trying to bring the fiscal house in order. And what you see right now with this bill is that this is going to add trillions, whether it's the CBO, whether it's Penn-Wharton budget model, which is a little bit more of a dynamic scoring. This is going to add trillions over the course of the next 10 years. But Jonathan, what's the alternative? If they do not do this, which the baseline of this bill is extending Trump's first era TCJA tax cuts, it's going to be a massive tax hike for American families. And that is something that is politically untenable for this Republican Party.
Nela Richardson of ADP has dropped by to catch up with us this morning. Nela, good morning.
Good morning.
Let's start with jobless claims. 227. Just continued resilience, which is a theme that you keep going back to repeatedly. What underpins that resilience at the moment?
Well, the labor market, if you look at it in a snapshot, is really, really stable. Companies are keeping their workforce. They're not letting them go. That's why we see such low initial jobless claims, and workers are by and large staying put. So the snapshot of the U.S. labor market is solid. The problem is if you look at the labor market in motion, the churn is gone. People are not leaving. Firms are not hiring in mass. And so you don't see the dynamism that has defined not only the labor market, but productivity growth. And if you really want to look for the crack in the labor market, go back to the last measure of labor market productivity. Output per worker was down 1.4% year over year. That's a sign of the drag that's going on right now.
When you see a low churn dynamic like the one you described start to grip the labor market, typically when you look back, how long is that sustained before things break one way or the other?
I don't think we can go back to priors. I mean, if I look at the great financial crisis, for example, the unemployment rate was above 7% for several years. Now, we're not even at the starting point of that great financial crisis. We're at 4.2%. The unemployment rate has been remarkably stable. And I think that's because there's so many demographics that are shaping that rate. Lots of retirees, a slowdown in immigration. There's going to be labor shortages that are persistent. So it's hard to really capture the labor market in one number, harder than it has been in the past.
What do you think about immigration policy? Do you see the unemployment rate actually going down?
don't see that, actually. I actually see those shortages in certain pockets of the labor market. What's interesting about this labor market versus 2022 or 2023 is that there are no superheroes. We could rely on leisure and hospitality to be the stalwart in the labor market, or healthcare more recently. We're not seeing that now. So who's going to save the day and bolster jobs into the future? Well, there's no sector that's doing that. Immigration is actually the lack of the labor supply is likely to keep wages very tight and robust, which is a problem for the Fed, who's looking to bring inflation down.
If there was to be a superhero, though, wouldn't it be AI and the supply chains around that, these data center build-outs?
You know, that is a long-term play. I do think that AI increases what contributes to American exceptionalism, which is productivity growth. And so if AI can make workers more productive, then there is a chance that we grow our way out of some of these problems. But the problem is, it's not just the technology, it's the people. And right now there's a gap between the two. Is the technology hitting the workforce in a way that increases labor productivity? We have yet to see that.
Let's talk about a potential problem. This morning, yields are higher, up by 5 basis points. The very long end of the curve is getting all the attention. The 30-year at the moment at 5.14. We've sustained this expansion. We've been running GDP around 3%. With rates close to where they are now, these are cycle highs. We're through those levels, granted, but between 4 and 5%. We've seen Fed funds between those levels now for a couple of years, and we've sustained the expansion. Is there any reason to believe that this breakout puts the brakes on this economy?
You know, there's so much, as Annmarie was saying, there's so much to be determined in this particular bill. We can't think that the levels are sustained at where they are today. There's going to be a lot of movement. And I think it's also the speed of the increase that matters in terms of yield. So it's not just the levels, it's the churn and the volatility in those numbers that will ultimately decide the short term. But longer term, this country is built right now, the economy is based on interest rates that are much lower than where they are now. Yes, housing, mortgage rates were higher in the 1980s, but house prices were a lot lower. And now we live in a world where house prices are very, very high, and you match that with higher interest rates, you're really going to get a cold breeze in the housing market, which trickles into other parts of the economy.
Well, this is the problem the Federal Reserve's got. As you know, Nela, they cut rates by 100 basis points and mortgage rates went up. Yeah. Have they lost control of the long end of the curve, if they ever had control of the long end of the curve?
That's not their sweet spot. That's not where they make those money moves. They make it at the short end of the curve, and maybe at best the 2-year. But really the 10-year, that is reflective of not just the U.S. economy, but the global economy. And if the global economy shrinks away from U.S. debt, not necessarily because of preferences, but a slowdown, then you're likely to see those mortgage rates continue to hold at the levels they are, or even edge higher.
Well, Nela, when it comes to the Fed, they've been talking about the fact that they don't have all the, dotting the I's, crisscrossing the T's, but they have some now. They have a little bit of a blueprint of what's going to happen fiscally in Washington. Do they start talking about that now?
It depends on how much they want to show their hand in terms of whether whether they increase rates or lower rates. And I still think that's an open question for the Federal Reserve, because as you know, there are a lot of things that are changing in the macro economy. And those changes right now look to be inflationary. And so I think they want to give it a little more time to be certain that the next move is a rate cut before they start contemplating that publicly.
Nela, it's good to see you, as always. A lot to think about. Nela Richardson there of ADP. Also need to think about this rates market and what's happening at the long end of the curve. Yields just off session highs, the 30-year now at 5.13. Ira Jersey of Bloomberg Intelligence is jumping on to weigh in on all of this. Ira, as you know, new cycle highs at the long end of the curve, levels we haven't seen going back to 2007. Over the last few years, when we've got to these levels, it's been difficult to sustain them. Either people have stepped in and they've bought, or it's forced corrective action at Treasury. Ira, do you believe these levels can be sustained at the long end of the curve?
Yeah, there is a big buyer base that likes these types of just over 5% levels, but we haven't seen people taking advantage of that the last couple of days. So I do think that at least temporarily we could probably sustain the long end above 30 years. Keep in mind, the last time that we were close to these levels, so the last time the cycle highs back in 2023, the yield curve was much, much flatter. So we have to keep in mind that there is different dynamics for both supply and demand for the 30-year and, say, the 10-year. So you have seen a very substantial steepening of the yield curve over the last couple of months, and that just keeps on continuing the last couple of days. Whether it's 10s, 30s, 5s, 30s, 2s, 10s, all of those yield curves are steeper today than they were just a couple of months ago.
And apparently 20s matter too. I've got to get your thoughts on this. Since when did the 20-year auction move markets as much as it did just yesterday?
It never has. I mean, granted, 20s are a relatively new and unloved sector in many respects. And this narrative, by the way, that everyone's saying that the 20-year auction was weak yesterday, it wasn't. It was actually better than February. It was way better than November's auction. So, and those were the last two refunding auctions. So the idea that it was very weak, it was a meh auction. It wasn't great for sure, but it wasn't terrible. And I think that this just shows that the psychology has shifted, particularly in the long end, because maybe of the long-term fiscal risks that remain out there with the new budget deal not being as as contractionary as people thought. They're still going to have very high deficits. I think there is a certain amount of fear out there that there's not going to be any type of good budgets anytime soon, and that means that it's that people are just shying away, particularly from that long end of the curve.
Ira, to your point, the 20 is considered to be the orphan on the yield curve, and you can see it for anyone that brings up the chart. The belly of the curve seems to be the sweet spot for a lot of people in fixed income, which brings me to next week when we get these auctions. 2-year supply at the front end of the curve comes next Tuesday, I believe. On Wednesday, we get 5s, and on Thursday, I believe, we get 7s. Do you anticipate any problems whatsoever when we get issuance across those kind of maturities?
So I think the 7s are going to be the most interesting of those three because, as you mentioned, there is this bid because, especially in the front end, the 2-year would have to almost double in yield in order for you to lose money over the next year. So there are a lot of people who are buying the front end as an alternative to buying money market assets, and particularly those people who think that the Fed's going to cut interest rates sometime over the next 12 months. But the 7s are kind of the spot that's in between the long end and the short end. So I think that's the auction that might have some trouble. That's exactly what happened, by the way, in 2022 when we saw a few weak auctions. It started with the 7-year.
And the 7-year this morning is just about unchanged. Ira, appreciate your time, sir. Ira Jersey of Bloomberg Intelligence stuck right back in the middle of that tension between the front end and the long end. The front end's rallying, yields are lower by 2 basis points on 2s, 3.99. At the long end of the curve, 30s are by 4 or 5 basis points this morning to 5.14. Nisha Patel's with us here in New York now, joining us from Parametric. Nisha, good to see you. It's been too long.
Yes, it has. Good to be here.
The long end of this curve, does it get bought? Can we sustain levels at these kind of levels?
I think we're starting to hit that ceiling, right? You start to hit yields north of 5%, and you take a look at everything that's been priced into the equity market, right? We've seen a very sharp rebound. Equity market is saying, look, everything's good, nothing to worry about. A lot of optimism, I think, in the equity market. I would argue in the bond market, we've almost priced in a lot of what has been feared, right, especially in the debt and deficit side. So I think this is kind of a ceiling where you start seeing buying opportunities. Look, I think for fixed income investors, the biggest thing we've been lacking for many years has been the income aspect. The duration play is another story, right? So going out on the long end, you're taking a duration play, which you can make an argument at this point in time with no slowdown or recession risk in the markets being priced in. I almost think that that's being undervalued, right? Fixed income investors may not be positioned for this slowdown. We had a claims number this morning, came in maybe right in line with expected. But if we start seeing any cracks on the job side, in labor markets, in consumer spending, I don't think we've seen that being priced in the bond market, right? And that's something that I think we're not fully taking into account.
In years gone by, that would be a good argument to anticipate lower yields on the long bond.
Yeah.
But now people are coming on the programme suggesting that given the concerns that are dominant at the moment, that if we go into a downturn, you could see, and I don't think it's the base case of the consensus view right now, but you could see yields climb, not fall, because the dominant concern right now is the deficit.
Yes.
How much comfort can you take from the 10-year and out in a downturn?
Yeah, I mean, look, I think also you've had kind of this trifecta of three things happening in a short period of time, which is why you've been seeing kind of the long end pricing in a lot of concerns around deficits, right? So Moody's downgrade, you have a tax bill which is coming in nowhere near the amount of cuts that people were expecting or wanted to see. And, you know, you have kind of just further concerns in regards to tariffs and that not coming in anywhere close to the revenue that was originally being generated. So I do think that 10+ year part of the curve, look, you're going to continue to see some volatility, right? Finding natural buyers in that part of the space is going to be very tricky. But I think this is an entry point where you do start to see, again, looking at real yields, you're starting to see very attractive yields in that part of the curve. I think for our fixed income investors with, you know, kind of an income bias, we would even argue stay in the belly of the curve, right? It's all about stepping out of cash, moving out a little bit in the yield curve. And there's, I think, a tremendous opportunity from an income perspective.
Since Trump won the presidency, everyone just kept telling me this tax bill is priced in. So why all the consternation now?
Yeah, I think it's a few things. Up until this morning, last night, we really didn't know what was going to be kind of fully implemented. And we still don't know, right? I mean, this is the House version. There's a lot that's going to be changed. So even early on, again, what I would say is while a lot of these components were known, I think it's a little bit of a confluence with the Moody's downgrade, right? And you have kind of now these reignition of debt and deficit concerns. Keep in mind the economic data has held up fairly well, right? So it's like the bond market's like, look, we're not worried about that for now. So we're going to focus really on the debt and deficit side. So I think you're seeing that now being priced in. And again, there is this worry that this bill, again, does not have enough. And that's basically what the bond market is saying, right? So it's going to be very tricky for the Senate. Look, they don't have to take any of these components, but to really come up with something that is going to satisfy not only bond markets, but overall markets to really suggest that the administration's doing, you know, kind of a significant enough job here. And then again, the tax cuts aspect, that's something that this administration definitely wants to do. It's getting very challenging to come up with the pay-fors on the other end to make up for it.
You mentioned the downgrade from Moody's in the last week. If I go back to the previous downgrade from Fitch, I think that was back in 23. And that landed around the same time we had the quarterly refunding announcement, which spooked this bond market and ultimately forced a degree of corrective action from the Treasury Secretary, then Treasury Secretary Janet Yellen, who tightened up the average maturity and started issuing a ton of T-bills. Do you think we need this time around also corrective action either from Treasury or from Congress in some form, maybe reshaping this tax bill going through Congress right now to put a lid on some of the volatility, some of the moves we're seeing at the long end of the curve?
I think those tools are definitely there, and I think that's a great example. It might be too soon to really come out and say anything needs to be implemented, but I think this is where kind of your Treasury auctions, again, to your point, you're going to have to see a different structure of issuance, a debt financing to really help support the long end of the curve. This shot up in yield has happened, I would say, relatively kind of recently in a short period of time. But I think we need to see a little bit more. Again, more economic data. I don't expect anything to happen over the next 2 to 3 months, whether it's from a monetary policy standpoint or even in terms of Treasury Secretary coming in to kind of step in. I think the economic data here is going to be the focus. July 4th time frame is going to be very important. And I think that's, you know, we're all hoping for a quiet summer here, but I think that may not be the case. So, I mean, look, for our clients that, again, have a higher quality kind of typically mandate that are looking at fixed income as a ballast, look, we're suggesting if we haven't been kind of, if you've been underweight fixed income, here's an opportunity to at least step out, lock in some income. And again, this bond market, I think, has become almost too optimistic. We have completely priced out any, I would say, slowdown risk. I hesitate on the word recession, but any risk of slowdown.
Greg Peters of PGIM said that. Jamie Dimon at JPMorgan said that in the last week as well. And Nisha Patel at Parametric just said it right now. Nisha, it's good to see you.
Yes, good to see you too.
You're in good company, that's for sure. We need to talk about this bond market. Look, if I was in the Treasury, and we've not caught up with Secretary Besson for a number of weeks, but I imagine he'll engage with the media over the weekend at some point again to talk about this. I'd be pointing to what was happening elsewhere as well. What can they do about the BOJ? What can they do about the Japanese government bond market? What can they do about the debt load there, the hot inflation in the UK, the stimulus bonanza that the Germans are about to go on as well?
Well, these conversations likely happened. He is right now at the G7 finance ministers meeting and central bank ministers meeting in Canada. Yesterday, he met with his Japanese counterpart. He met with his German counterpart. So I'm sure these conversations are happening. How much we could report out of them potentially, that might be a little bit challenging. But these conversations are happening because this is what Neil Dutta said to me yesterday when we were talking about the fiscal package. He's like, you can't just think of this as an idiosyncratic U.S. government issue. This is happening around the world.
Really interesting moves developing in fixed income. Yields up at the long end by 3 basis points. Off session highs, we're back to about 512. How much will that constrain this equity market? At the moment, this equity market is bouncing, so we'll see what the open brings. We're now negative by about 0.2%. Let's give you an update on stories elsewhere this morning with your Bloomberg brief. Let's cross back over to Yahira. Hey, Yahira.
Hi, John. Recapping the latest economic data, U.S. jobless claims fell last week to 227,000, the lowest level in 4 weeks. The median forecast in Bloomberg's survey of economists called for 230,000 applications. The data adding to signs the job market remains healthy. Meanwhile, President Trump taking to Truth Social this morning to congratulate Speaker Mike Johnson and the Republicans who voted yes for his tax bill. Trump said the bill is arguably the most significant piece of legislation that will ever be signed in the history of our country. The bill narrowly passed the House by a vote of 215 to 214 and now moves to the Senate. And a check on Nike shares. They are higher by 0.7% in the pre-market. The world's largest sportswear company announced it's returning to Amazon's online store for the first time since 2019. The return to Amazon is part of Nike CEO Elliott Hill's push to revive relationships with retail partners. That includes stores as well, like Dick's Sporting Goods and Foot Locker. That's your Bloomberg brief. John?
Yahira, thank you. Thanks for this morning. Up next on the programme, we'll set you up for the day ahead and get you the latest from the nation's capital, which is shaking up Wall Street big time at the long end of the yield curve. Live from New York City, you're watching Bloomberg TV. Over the years, it's been difficult to sustain these levels across the yield curve north of 5% on a 30-year maturity. Typically, investors step back in, or it forces corrective action down in Washington, D.C. It proves to be somewhat self-limiting. This morning, we're just off the highs. Yields now up by a basis point or two, 510 on 30s. We'll see if we can sustain these kind of levels. That's the bond market. In equities, we recover just a little bit, going into the open in about 36 minutes away. Equity futures negative by just 0.1% on the S&P, and the Nasdaq 100 flipping into positive territory in the last couple of moments. Interesting session already. Interesting session as we work our way towards the long weekend. This Thursday into Friday. Your trading diary looks like this week. 9:45 a.m. your next data point, PMI data. Then at 1 p.m. a White House press briefing. Look out for that. Friday, the U.S. Treasury market closing at 2 p.m. Eastern time. Monday, of course, U.S. markets will be closed for Memorial Day. As we look ahead to next week, Wednesday, the big earnings report. Why do we have to wait so long? Nvidia finally reports earnings next Wednesday, so look out for that. I want to touch base with Washington and head down to Tyler Kendall now, just for a quick beat. Tyler, it's passed the House. For people just tuning in, that one big beautiful bill has advanced to the Senate. Just describe what the next few days, the next several weeks, all the way through to July 4th might look like.
Yeah, hey, John. Well, it's going to be a pretty tough battle when this House text does get over to the Senate. We should say it's Memorial Day. They're all getting out of town. They'll be back on June 2nd to pick this back up. But if there were concerns about deficit spending in the House, wait until we see what ends up happening with the Senate, because they've already raised some pretty big concerns here about some of those saving policies that fiscal hawks push for, like those work requirements when it comes to Medicaid and rolling back clean energy tax credits under the IRA. So we're going to have to see exactly what sort of deals end up shaking out here, as we know that this White House wants to get it done by July 4th. Perhaps lawmakers will have a little bit more buffer room, because the real hard deadline is going to be that X date, which right now is projecting to come in August.
Tyler Kendall, thanks for the work this morning. Looking forward to your reporting through the day. Speaker Johnson with a big smile this morning. He got it done.
Self-imposed deadline, and he was able to land the plane as he promised last night. He thought they were going to be able to do it. A lot of backroom dealings. I want to know what was promised. The fiscal hawks, the House Freedom Caucus last night in the Oval Office with Speaker Johnson and the president. But the Senate's going to rewrite this bill. This is the first chapter.
Let's take a beat. They get the long weekend. You get a long weekend. You're leaving today,
I'm on DC
right?
time.
You go and enjoy yourself. We'll be here with you tomorrow morning with Sebastian Page at T. Rowe Price, Dan Greenhouse of Solis Alternative Asset Management, the Kayak CEO, Steve Hafner, and Nadia Lovell of UBS. Plus, Bramo's back to talk about this bond market. Looking forward to that from New York City this morning. Good morning.